Good morning, Vivek. This is Ravi. How are you today?
Hey Ravi, I'm good. How are you doing?
Very good, very good. Thanks. Thanks for again your timing everything with us.
Oh, you're welcome, welcome. I'm glad that you continue to join.
Yes, it's
Yeah,
very knowledgeable for me. Since
that's
I
nice.
joined you, I'm getting day by day everything like new things. So better than nothing. Otherwise, I will see the movie, Hindi series movie on Netflix.
Uh,
So which is nothing.
I- so regarding Netflix, I remember when I think it was in 2015 or 2016 sometime, when I decided that I really want to take, investing, and especially I think it was 2015. I wanted to learn about options and wanted to spend a lot of time in learning about options and investing. So first thing I did was to get away from Facebook, and second thing I did was to get away from Netflix.
That's true, absolutely. In
So,
pandemic, 2020, right? I
mhm.
did watch lots of movies, so I wasted lots of time.
Uh,
Yeah.
because
So
I knew I had to find time from something, and along with the job, and then on evenings I had to take my kid from one place to another, and she used to see me that I'm always watching some podcast, etc. While I'm driving, but that was a good. I think that was a I was away from Netflix and for 2 years,
oh,
but Facebook I have not gone back. So
okay.
Facebook used to be a time sink, man. I left it. I'm so glad I left it. I gone back into Facebook as an investor, but not as a user. I love as
That
an investor. I don't
that's
like it
true.
as a end user.
That's true. That's
It,
true.
it used to be a time sink.
That's good. So what's today? What's in pocket today for
All
us?
right. Yeah. So yeah, we'll talk about it. Let me see if who else is there? Anyone joining here for the first time? Any first timers? Any new joiners? Come on, speak up if you're joining for the first time.
Yes, this is Elaine. Hello, this is my first time.
Hey, Len. So what brings you here?
Oh, just looking at opportunities to network and find out more information about investing.
Cool, cool. And have you been investing? And I mean, what kind of investor you are?
Yeah, I'm I would say kind of beginner to
Mhm.
moderate investor. I'm a CPA, so I'm more tax heavy um and so forth, but really want to look at options and investigate that further.
Cool. All right. So since you're CPA, you can be very helpful to the group when I try to, look into the financial statements. And probably I might be doing some things wrong. So you can correct me. This is how you need to look in.
No, no, only here to help, help and guide for sure.
All right, welcome. Louis, I was saying she is new. Louis, do you want to introduce yourself? Maybe a quick intro of what kind of investor you are and what are you looking to get out of these discussions? Louis,
Hello, good morning.
morning.
I I've been investing, I would say, since the year 2000, and I've made a few mistakes along the way, but so far it's working pretty good. However, I would like to learn a little bit more about getting more money for uh, income, monthly income.
Cool. All right, good. So you've been investing longer than I have been. I wasn't even in the United States in 2000, but yeah, I have read all the and heard and read all the stories around what crazy stuff was happening in US, especially during the dot-com, because I was working in the tech sector, so we did get impacted even outside US. Uh, but yeah, those were the days. Yeah. Anyone else new before? Yeah, we have 5 minutes over the hour. And if there is, we probably have time for one more introduction. Anyone else joining here for the first time? Uh,
Excuse me, sorry to interrupt. I meant to say 2020.
Oh,
Did I say?
2020.
If I
Oh,
said
okay.
2000, I made a mistake. I
Oh, yeah,
meant to
you
say
said
2020.
2000. I'm like, oh, you're a veteran then. You've been through many cycles. Okay, 2020. Okay.
Yeah, hello, Nigel Waits. My background is technology. I'm a computer engineer, and so I've sort of obviously been investing for many, many years as I grew up through the tech revolution. And right now, obviously, I'm very AI stock heavy,
Yeah.
and trying to navigate through this interesting time.
Yeah, if you're suddenly a lot of it's an interesting couple of years for the technology sector. Even as if you are working in tech sector or if you're an investor in tech sector, it's been very interesting years. And we today again we'll talk about a little bit on the AI stuff. I'm hearing a lot of news and expert comments around AI bubble, not bubble. So we'll spend a little more time on that as well today. All right. I guess let me see, quickly run through who else is there. Alan, Alfred, Barbara, Elaine, Elena, Jay, Jose, John, all familiar names. Kristen, welcome. Lilia, Louis, Matt, Morris, Nigel, Pranav, Pushkin. I think you've been here before. Ramesh, you've been there, old timers joining for the 5 years almost. Ravi, Ray, Ray Coden. Hey Ray, is this your first time or you've been around the block on Saturdays earlier also?
I've been here before. Sorry, I'm kind of semi-distracted right now, but I've been here before. I think we
Okay.
talked about like Stride last time.
Oh, okay, okay. Cool. Thank you. Thank you for joining again. Rick and Rose, Sam, Sawyer, Sophia, Shri, Sridhar, Tushar. Yeah, all other familiar names. Okay, so let's get started. Alfred is saying crazy week today, back and forth overnight, Friday morning, night. Yeah, I don't even look at and Alfred, you always have very interesting and very, I would say, populated charts. Not that that's not my cup of tea. So and really didn't matter this week. I think this week was better than the last week, I would say. And as we look into it, I mean, markets are still doing okay. So I'm not worried about what happened this week. It's crazy. Yeah, maybe if you're looking to profit from a daily movement or from a short-term perspective, yeah, it is crazy. Can because it was like a little more volatile, but overall, I think we're still doing fine. Right? Yes, SPX and week 5 points higher. Okay, so let me share my screen and then we'll get started. Okay, hopefully, can you please confirm that you're able to see the screen?
Yes.
Okay, that's
Yes.
okay, that's cool. So, uh, so welcome everyone to our discussion number this 300th discussion, right? Reminds me of the Spartan movies 300. We are the warriors fighting against the inflation, trying to do best that we can do with money that we earn. And if we do not let money work for us, we will have to work until we die. And I just hate the thought of that I'll have to work, till I'm on my deathbed to just make ends meet. So
Hey,
that's what I
Vivek.
started investing, and now full time as an investor. Sorry, someone had a question.
Not a question. Just wanted to do a shout out to you. Congratulations on number 300. That is a really great milestone.
Yeah, thank you. Yeah,
Seriously.
I never thought we just started with a couple of friends almost 5.5 years ago. I just started on a Zoom and then a few more asked for it. So I thought, okay, I'll create a meetup group. And that's how we started. And now we are at number 300. So
Through
and
the years,
thank
you've been very helpful. So thank you.
oh, you're welcome, Maurice. And thank you for showing up. You've been here for almost, I think, 4 years plus. So thank
Uh,
you for
on and off. Yeah.
Yeah. Oh, no, that's fine. Thank you for your patience. Uh, so, so today, so we just finished 45 days after Q3, and those fund managers who have at least $100 million under assets, so they do invest in public equities. They are supposed to file a document called 13F, and that gives us insight into what the so-called smart money have done with their portfolios. What was their situation as of end of September 2025, right? And this is one place wherein a lot of investors will look into it. They will review 13F, and if you're on Twitter, you will see it is littered with, Warren Buffett bought this or Bill Ackman sold this, etc. So you can go and look into all those individual 13Fs. But what I want to do, and I've started doing it almost now for 4 or 5 quarters, is I combine the information from almost 89, 90 fund or 80 plus fund managers to see what at a high level collectively they are doing, right? So maybe one fund manager bought one particular stock, but hey, how about the rest? How does it appears in when I look at over the combination across all the investors? So I always view it on a different theme. So I will discuss those themes with you. That'll be one topic, and of course we look into the little bit on the macro side. We'll look into on AI, a lot of narratives around AI. I also want to talk about box spread again. I think last time I discussed box spread option strategy was maybe a few months ago, maybe 6 months ago, but I did that again this week. And I know on Slack somebody had a question that how does this work? I'm like, okay, this is how it works. So maybe I'll talk to that about that again. What else? I think these, yeah, and couple of earnings. We still are in earnings season, and some of the stocks that I hold are still reporting earnings. And then we have a big earnings coming up this week, which is Nvidia, right? So that's if anything, anyone paying attention to any earnings this week is going to be Nvidia. I think all other are probably, yeah, it's okay, but Nvidia is what is going to command a lot of attention this week. So I'm not saying for whatever reason Nvidia reports very late. So, but it is what it is. So next week, so yeah, we'll see. This week also could be volatile because of Nvidia earnings. So, but be careful. Let me just pull up capture the chart for this week's earning also. All right, so that's all I have on docket, and then at the end we'll also break out into different breakout rooms and just chit chat like how we chat among friends. Alan is saying, I mean, if Buffett is buying Google, how can you be bearish? Yeah, they opened a position in Google after many years. Now they bought Google. Asif saying amazing milestone. Thank you, Asif, and thanks for your patience in listening to me and participating in these discussions. Rick and say would be interested to hear about Michael Burry betting against Palantir. I'm not surprised, but let's talk about it. I do have that on agenda. Nvidia is the finance Super Bowl. Yes, always. All right, so let's get into today's discussion. As always, everything that we discuss here is only for education, so don't take it as an investment or financial or tax advice. If you want a tax advice, now we have a CPA in the room. I don't know, Elaine says she's a CPA. Might do, you'll do better if you talk to her instead of taking investment or a tax advice from me. All right, so to start with, I always want to start with some thought or a quote. The quote that I picked up, or the word I picked up for this week, is boldness. Right. I'm a big fan around of behavioral investing. I think investing is more EQ game than an IQ game. It's pretty simple, right? Investing is pretty simple. There is you don't have to be rocket scientist. You don't even have to be a college graduate to invest in the market. but it is not easy because of behavioral issues. So the word I picked up for this week is boldness. And I think this is a quote from Charlie Munger, which says, boldness without backup is just arrogance with better lighting. Right? And when the markets are good, markets is bullish, markets are going up, everyone become a little more bolder in terms of how they want to invest, because we always assume it's going to stay like this. Right?
Vivek.
Another, yeah, Sam.
There's an article that 90% of Americans are living paycheck to paycheck, and I looked at their expenses. They waste a lot of money. I mean, look, I didn't think I could be a good father, so I didn't get married. I didn't think I definitely I don't drive, so I mean it's kind of and like 75% don't invest in any stocks.
Yeah.
So you have to have financial education.
So, but financial education college doesn't teach anyway. So, but I think the 90% number is probably it's overstated. And in US, I think now at least 35 or 40% of the families, they do retail, mom and pop investors, they do invest in stock market. So the numbers are higher. But I agree in terms of a lot of families still live paycheck to paycheck. And I mean, it's simple. Like again, I'm saying investing is not complex. Very basic rule: live within your means, save always, and just invest in index funds. You don't have to complicate the investing anything beyond that. But unfortunately, we all want to look for, want the flashy stuff. We all want to catch up with our neighbors. We are more interested in the lives of other people on what they're posting on Instagram rather than looking at, can I even afford to do this or not? We all want instant gratification, right? So then you get how you build your life. Not surprised that you live for paycheck to paycheck, but if you dig deeper, probably they're spending a lot of stuff on the you know things that they probably can cut down on, or they're trying to impress the folks who don't care about themselves. Now it's a different matter if your income is low, but I have known and we have seen people who make decent income, but they still live paycheck to paycheck. The end, when you're talking about investing, it's not how much you make. It is how much you're left with after you have your expenses, because that's what you're going to invest in. Low income families, agree, they're struggling. And at least on the US side of the economy is like becoming barbell. We have a lot of wealth concentrated among few percent, because they own financial assets, they own stocks, they own real estate, whereas those who are on the lower strata, they never save enough to even begin investing. Right? So, but and that's what, when I came to this country, I was like, I don't know how this stuff works. And I came to this country very late, right? I was already in my mid 30s, and I'm looking at, if now I'm starting my journey in this country, I'll never be able to retire with enough corpus that I can live on treasury bills. So that's what my motivation was, to figure out how the investing works, because I didn't have many years to build my 401ks, right? Imagine, and I'm happy, like my kid, she already has a 401k. She's not even mid 20s, right? For me, I'm like, there is no way I can depend on 401k income, because I'll never be able to build a corpus. So I have to figure out how you invest, and that was my motivation. Right? Anyway, coming back to the quote, and yeah, if you have a question, raise your hand, and I'll invite you to talk. and ask your question. Other Regarding boldness, there are bold investors and there are old investors. There are no bold old investors, because if you're really bold investors, where you say, you know what, I'm going all in, and I see this on Twitter, I'm going all in on this particular stock because I know this is a great company, I know this is amazing business. But the reason why there are not bold and old investors, because those bold investors, they blow up their portfolio. We have every new season will bring in a new breed of bold investors, and then when the market turns the other way around, and it will always happen. Markets are generally cyclical. Sometimes the cycle are longer. Sometimes the cycle may be 10 years, 15 years, but it always go through euphoria, optimism, euphoria, bubble, crash, desperation, the typical market cycle diagram that I've talked to you about many times. And that boldness come to bite in the back, and people get wiped off, right? So there are no extra points in the market trying to be bold or trying to be super smart or trying to do complicated stuff. We don't have to. We need to just make sure, and the way I want to invest is, I don't want to out earn any other investor in any year. I want to outlive other investors. If I can outlive, or I can just stay invested for long, that itself is good enough. So I don't have to take a bets which, hey, if it works out, probably will become 10x, 50x. But if it doesn't work out, gonna, wipe off the portfolio. So I don't want to take those bets. So you don't make money by outsmarting others, you make money by outlasting. I think this is what I was just referring to, is just figure out how you can outlast in this market. Even if you don't have any other investing in broad based index itself over more than a century has given you 10% return. Not that is every year it is 10%. I think the majority of the time it is not even closer to 10%. Either you will see S&P doing like 20%, or at least last 2 years it was above almost 25% per year. This year we are now 14%. 2022 we were like negative 18%. So you will see wide fluctuations, but over longer period it averages out to be 10%. So even if you don't do anything, just invest in S&P 500 and manage your portfolio, manage your behavior, that you don't get scared out, don't take stupid bets, you'll still do fine. We tend to overcomplicate it. We tend to try to take those moonshot bets, and it's our stupidity that prevents us from making money. It's not that we need intelligence, like Charlie Munger says, right? Always invert. To make money in the markets, you don't need intelligence. You just need to cut out the stupidity from our own investment process. So as long as you cut out the stupidity from an investment process, we will do fine. All right, with that dose of investing mindset, like today's theme was boldness, let's get into what happened this week. So looking at a traditional TradFi market, so government is now open for business. We had the longest shutdown in the US government for almost 43 days. I'm sure some of the families probably felt the impact of it. Some of the benefits were cut down, like SNAP benefits, etc. But overall, from a market perspective, for investing in the market, didn't see much of a difference. Right? Market is still doing okay. So sometimes I wonder, do we really need big bloated government if some of those markets and the activities can function, economy can still function without the market? Yeah, there are some programs for which we do need government, but maybe there are many areas where probably we don't even need government. Right? Why we need to spend so much on US government? Anyway, so 1.4 million federal workers will be back on jobs and will get paid. Other thing is that all the data that we used to receive, US economic data, labor data, we did not receive during the shutdown. And now we will start to get that data back again. I don't know if we'll be able to backfill all the missed data. So it's anybody's guess that when we receive the data next, is it going to be accurate or not? I don't put too much faith on the the employment data or the BLS data that comes out, because over few years, ever since it started tracking or reading about this data, every quarter they will revise it. It'll get revised. The previous month's data get revised, and sometimes the revisions are like 80% or 90% or like off. What the heck? Why should I even depend on a data which then get revised? That our error rate, we were like 90% off or 50% off. Doesn't make sense. Maybe we have to find alternative a data which is, we have a technology to do it, right? It is in today's world, it seemed very archaic that the way we collect some of the data is actually sending out the forms to people or maybe calling some households and have them respond. But this is what BLS does, which is crazy, right? we have data coming from some of the private sectors, ADP. If you want a housing data, you go to Zillow, go to Redfin, go to apartments.com, go to rent.com. You don't have to call up and then conjure up owner's rental data to figure out what the rent is. Like, we have a live data available, use that. So I think the shutdown, maybe in some case it probably exposed that maybe we don't need all those departments. We may be able to survive. There are a few areas where we will need it, right? We had like Alan is saying, airports. Yeah, we need those air traffic controllers. We had a disruption in air travel. Many of the flights had to be cancelled because we don't have enough ATC people. Yes, there are some areas where we need them. Do we really need the big bloated BLS? Probably not. Do we need 400 PhDs in the Federal Reserve and they can't even figure out where the inflation would be? Probably not. Right. Anyway, so while we had a funding bill through the end of January, so another drama after January, I just hate this. We should just take off this debt ceiling and move on, right? But question on healthcare premium is still outstanding. So which actually showed up because I was trying to renew my healthcare and it showed me like premium is now what 25% more than what I've been paying now for the renewal. I'll see. The other impact of the shutdown, CBO, they are now estimating that the impact of shutdown will be maybe 1.5% in Q4 because again government spending is one big part of our GDP growth. Like it or not, it is what it is. So if we did not we had a government shutdown for 43 days, it will impact some of those spending and that will show up in our GDP. CBO is estimating that our GDP growth will be only 1.1%, but now the government is open, so we should see it picking up back again. On the stock market, what did we see? First of all, we saw that the probability of rate cut is now back to coin toss, which is very different. I remember, I think maybe, was it last week or a week prior to that? I see a hand up. Well, I'll come to that. One sec, Sam. So let me just finish the stock market reaction. So it was almost 80% a rate cut for December, between 70 to 80. I think it was almost 80% plus that we're going to get another 25 basis point rate cut in December. Now it is like 55%. It's almost coin toss, And I think maybe some of that has to do with Fed doesn't have any data. We don't know how the data will show up. We don't know how the labor number will show up or how the inflation number will show up. And the market is like little concerned. And I think there were also some Fed speeches around now those Fed governors can go and talk about, give speeches. So something market reading through that is it's no longer guaranteed that we're gonna get a 25 basis point cut. Even when we got the previous cut, Jerome Powell made it very clear that, hey, don't take it. He will never say that anything is guaranteed, but the message was clear saying, hey, it's not on the table yet. So we'll see. Jose is saying data, there's data incoming. Yes, there is data incoming, but we don't know how good or bad the data is. I think that's what the market is little concerned about. And it's a, maybe we will not get any rate cut. That's what the probability is, right? And if you don't get if you don't get a rate cut, then it means it's not good for those growthier companies. And we see that the tech was pressured over the last 2 weeks. So saw some sector rotation. A best performing sector was healthcare, almost up 6% in 2 weeks, and the worst performing was information technology, right? So and consumer discretionary. But even with these sector rotation, and obviously one of a big concern that we saw on the rotation was around all these mega trend of AI plays. And I think I touched upon this topic last week also. Market is still concerned about, oh, these companies are overvalued, right? Think about all like top 6. Tesla is overvalued, but nobody considered Tesla as an AI play yet. But the others, market concerned, overvalued. There are mega expectations that have been built in. Your OpenAI is planning to spend $1.4 trillion. What's an ROI? We have no idea. When you ask the CEO how you're going to even fund it, forget about ROI. How are you even going to fund that $1.4 trillion of expense? It get defensive and says, hey, you want to sell your shares? I'll find a buyer. That's not an answer you want to hear from a CEO. It's a very genuine question. That if a company is committing for $1.4 trillion as an investor, you need to know how you're going to fund it. And we have gotten no answer from it, right? All we got was a defensive move from it. So market little concerned around it. Hey, are we ever going to make money on this one? Or maybe the expectations are too huge, right? Shifting capital structure. We when it comes to the tech companies, we never thought about it. Hey, so they always raise money through equity, but now we are seeing money being raised through the debt vehicles. Never seen that before, right? And which also shifting business models. The reason why the tech has been enjoying that high valuation because it is a capital light business. You don't need to invest so much. Not anymore, right? Now you're becoming a capital heavy business. You're building data centers. Some companies are taking stake in energy power plants. Now your business model is changing. Should you even enjoy that multiples that you have enjoyed for last 2 decades? I don't know. I don't know what's the right one. But I think the question is that these things are changing. Right? Now if you say, hey, the multiples on the tech, they are extended, but not as much as they were in .com or not as much as they were like, may pick up another bull period. I don't think the companies of today are exactly in a similar position companies of yesterday's because business models are changing, capital structure is changing. So we need to also change the way we think about these companies and how we want to value these companies. Right? And the market is now getting a little jittery, and then we see some news on the AI coming. Go ahead, Sam. You had a hand up.
Sorry, actually, I forgot what I wanted to comment on. Sorry about that.
All right, no problem. All right, I'll move on. So talking about AI, let me first look at Ray's question. Ray is asking, have you ever considered sector rotation trading? Continuously rotating into new hot sectors with momentum. Why and why do you think about this type of strategy? I personally don't do it. So I personally only want to invest in the sectors or the companies, individual companies, which I understand, the businesses I can understand. And when it comes to the sector, do I try to reduce my allocation and increase on others? Sure. But majority of the time my portfolio will reflect what I understand and what I believe in. Now for example, over the last few months, I've been trying to, if my tech growthier stocks get called away, I'll be okay to have them called away and raise home more cash. Right? You guys know I've been selling Palantir ever since it was like $60 above. I couldn't justify why it should be more than that. And it is still like $175. I have a last lot that I will sell it, and I'll have no, if it goes to 250, let it go to 250. Right? So because I know that company from my perspective is too overvalued. But am I gonna sell the whole tech sector as such? Probably not. But I do look at some of the companies and I say, have they gone over their skis? If yes, then I will reduce the exposure. Right? And then I look at what sector do I not have an exposure on, and maybe because if I don't understand the sector, I'll just buy an ETF. I'll not buy an individual company. I'll buy an ETF. That's what I'll do. The other way I'll do is to reduce exposure is to basically sell or make use of options to reduce my overall deltas on particular sector. Let's say I've been selling a lot of calls on QQQs, which printed a lot of money this over last, I would say, 2 weeks, right? That means if the tech sector slows down or we see weakness, at least that while my long stock portfolio will get impacted, but I'll get some cushion from my calls on QQQs. So that's what I'll do. I'll just look at my portfolio. I look at overall deltas and see, you know what, am I still okay to hold so much of a delta? If not, do delta reduction trades. When it comes to individual sectors, it's more about the individual companies. If I find some of the stocks are, from my perspective, are too overvalued, then I'll try to reduce the delta on those stocks. At the end of the day, my idea is stick to what works for you. If you are able to identify sector rotation movements, maybe look at whatever macro sector, and that's been working for you, stick to it. Right? That's not something that I have tried a lot, but what's worked for me over the past many years, I'm staying with my game plan. Right? The best game plan is not what's making money in any given year. The best game plan is the plan that you can stick with for longer period of time. And so far, I think I'm trying to figure out what works for me and I'm sticking with that. So a lot of AI stuff in the news, right? Whether it's a private market, whether it's a startup pitches, whether it's a public market, it's all consumed by AI. I do go and judge, do my community service as a judge in a startup pitching event not every Friday, the last Friday of a month, and I've been doing it for almost now 6 months. And most of the founders, I mean 90% plus of the pitches are all related to one or other form of AI. Right? Whether it's an AI slop on an existing business model, most of them are like that. Very few I come across are which are actually trying to look at a new business. Probably have not come across anything so far, which is, hey, this business model is entirely new and has been created because of AI. Most of them are existing business models. How do we make it better using AI? Public market, all the companies that are getting the limelight or getting the most investor attention is all related to AI. 40% top 10 stocks in S&P is almost 40% of overall S&P 500. All are have done so well because of one theme, AI. Private markets, same story, AI story. So we're seeing a lot of discussions now coming around that, hey, are we in bubble? Like, maybe 3 or 4 weeks ago, I went through a report from Kotu. Kotu Management, again, an investor both in public and private markets. They had a report on, are we in a bubble? They tried to defend it that we are not in bubble. Depend on who you listen to. You have to form your own opinion whether it's a bubble or not. Don't go by what I say, what Kotu says, or what Howard Marks says. You understand and frame your own opinion in terms of how your portfolio is, how much you're exposed to AI. Then you have to decide, maybe AI in a bubble, but it's small part of your portfolio, still okay. Maybe AI is not in bubble, but your portfolio is like 90% AI. Even if it is not in bubble, maybe you will want to, lighten down on it. So, but this week we again had a discussion on AI in bubble because Michael Burry, who became incredibly famous during 2008, when and of course a movie Big Shot was made on based on what Michael Burry did during the 2008 crisis. And now anytime he tweets, he doesn't say much, but he tweets cryptic tweets once in a while, and then the rest of the CNBCs and the Bloombergs will talk about it. So Michael Burry bet against Nvidia and Palantir. He's calling it the top of AI boom. But if you follow Michael Burry after 2008, probably he has predicted maybe 8 or 10 top of the boom so far. So if you just followed him every time, probably you are way, you're not doing that good. So one day he'll come, he'll be right. Maybe this time he'll be right. Who knows? But after 2008, he probably made 10 predictions where he say, get out of stocks, get out of stocks. And then the stock is like up another 200% in 5 years or 10 years, right? So don't follow anyone. But market do get impacted by these headline news. And specifically the dumb people at CNBC don't even know how to put those headline news properly. So there was a news headline on Michael Burry had, they took a $1 billion bet against Palantir. Was it Palantir or Nvidia? One of them, right? And it's a huge, that's a big number. Right? People will take notice, market will take notice, maybe the stock will move based on that big news that is taken $1 billion bet. So what Michael Burry did, it was not a $1 billion bet. He didn't spend $1 billion of his money in taking a short position in these. Right? So Alan says, he tweeted it was only 9 million. What he said was right. He basically bought a put options, I think expiring in 2027. And the premium that he paid for that put option is $9 million, not $920 million. But the notional value, and those who trade options understand this, my apologies for those who are new to options, the notional value of those contracts was $900 million. It's not close to $1 billion. It's not that he spent $1 billion. But if Nvidia crashes and burn, then he will benefit, he will make $1 billion, which is a very different thing to say that I took $1 billion bet against Nvidia or Palantir or these AI. No, you didn't put $1 billion. You only put $9 million. And it's like if you bought a lottery ticket, you spend $1,000 in buying a lottery ticket, and if you get Super Bowl or whatever, I don't even know what the Super Bowl is, not lottery. What, Super Lotto? If you win the Super Lotto, you might win $1 billion. But you're not gonna go and say, I took $1 billion bet on Super Lotto. No, that's not the case. You invested maybe $10, $50, whatever number. So that's the difference. And the dumb people on the CNBC or this financial media don't even know how to differentiate between the notional value and the money that is spent, right? Whatever it is what it is. Actually, when you report 13F, when you're reporting your puts or a calls, you report the notional value. So if you're an investor looking at 13F, you need to differentiate between, it's not $1 billion bet. You don't even know how much he paid. And we talked about it, I think, last week. I said, I don't know how much he actually paid. And this week he came out and said, I paid 9 million in a premium. Yeah, okay, it's a big amount. Don't get me wrong. 9 million is a big amount for an investor, but it's not $1 billion what these CNBCs or Bloomberg talk about it. So he took it. Another one is something that I never knew that even exists, is like a CDS, right? Credit default swaps that became, this is what made Michael Burry famous in 2008, is he went and bought protection against default of the loans during the housing crisis. Now we are also seeing that the protection against Oracle defaulting on its loan. So this is what I said earlier, that the capital structure is changing. Oracle raised debt, Meta has raised debt. I think Google was in talks to raise money through a debt. So if you're raising money through debt, you need to pay interest on it, and then there will be a secondary market created saying, hey, what if Oracle is not able to pay the interest? I want to protect myself. You buy CDS. Those are the derivatives. And if the market is concerned that, or if the risk of Oracle not being able to pay the interest on the loans that they are raising, if that starts to go higher, you will see the insurance protection against will also become more expensive. And that's exactly what saw that Oracle debt derivatives, they start to jump higher because the traders are trying to hedge their AI bet, saying, what if Oracle raised what, I don't know, 40-60 billion dollars. What if they are not able to pay that much, no, or not able to come through that? So they want to have some protection. They bought those CDSs against these Oracle debts. Alan is asking, CDS on Oracle available to retail investors? I don't know. I don't know if those, yeah, like trade maybe on the OTC market, or these are the instruments that have been created by Wall Street firms specifically for big firms. Like when Michael Burry wanted to short the housing market, there were no CDS available. If you watch that Big Short movie, he went to each of these banks. He went to Goldman Sachs, he went to JP Morgans of the world, these big Wall Street firms, and say, I want to buy CDS against housing loans going bad. There are no instruments. But when he told, I want to buy whatever $1 billion worth of it, and Goldman Sachs said, sure, we'll create an instrument because they tend to earn a lot of fee. And hey, housing market has never gone a bad. So, this fund manager from California, Saratoga, which is pretty close by to my house, hey, this is a crazy guy who says that I want to short the housing market, looking for an instrument. They created for it. I don't know if the Oracle's CDS exists for retail market, for retail investors or not. Maybe you can Google and find it. And anyway, I'm not interested in buying that. So that's one concern. You are seeing famed trader slash investor Michael Burry shorting AI play. We are seeing Oracle that derivatives are becoming more expensive. Then you see another note from Michael Burry about, hey, you know what? These companies are playing depreciation games and they are basically boosting up their earnings artificially. When I say these companies, I'm talking about Google's, Meta's, all these hyperscalers, right? And this is not the first time. Maybe now he has a short position, so he's talking about it more. But if you recall, maybe a few quarters ago, maybe 2023, was it 2024, when I presented you with in terms of Alphabet earnings, I told you, hey, they are actually increasing their useful life of servers from 5 years to 6 years. So when you increase that, per year depreciation that you take goes down, it means the accounting profits get boosted up. So that's exactly what Michael Burry came and talked about it, saying, hey, you know what? Earlier this year, Meta had extended the useful life from 4 to 5 years and to 5.5 years. That will reduce its expense by $2.9 billion to, so 2025 depreciation expense. So that immediately everything falls down to boost your bottom line, right? It all contributes to net profits, even though it is non-cash. But when you're looking at an EPS, it's the accounting net profit, right? Microsoft and Alphabet all have made their moves in recent years, which is what I was talking about. Because when we reviewed the Microsoft and Alphabet earnings, you see it in the earnings release that they talked about it earlier. So nothing new. Skeptics argue that the depreciation should actually accelerate and not slow down, right? Because now we're talking about different kind of chips. We're talking about NVIDIA chips, which market says that NVIDIA is like innovating at a speed of light. Instead of coming up with a new generation chip every 2 years, this Jensen Huang said, we're going to come up with every new year, every year we're going to come up with the newer chips. We had a Blackwell last year. Now we're going to get a Rubin. Then we're going to get Vera Rubin. So the market is questioning, saying, those older chips, are they really worth that much? You know, uh, this is what the market is questioning. This is what Michael Burry is questioning. Those who are in it, if you listen to, those who manage the infrastructure for Google's and the Microsoft, they say, we can actually still use it for other workloads, right? You may not be able to use the same NVIDIA chips, let's say H100s, or earlier we whatever H20s, doing the trading, but there are a lot of other workloads in which we can continuously use those chips. We just move it in terms of what we need to use those chips for, and hence we are saying that we can use the chips for longer than what we anticipated earlier, and hence we are increasing the depreciation cycle. But I think the whole concern around is, if you add up all these hyperscalers and see, after extending those the useful life of the servers and the chips, etc., how much of an overall gain they have gotten from this accounting change. What Michael Burry says that it is almost, okay, well, I don't have the number yet. Damn it, it is some, I think, 100 billion or something like that over the next few years. So his idea on, oh, you know what, I want to short it because they are inflating their gains by billions and tens of billions of dollars, maybe $100 billion over the next 3-4 years, by employing these depreciation accounting moves. Anyway, I don't think he knows exactly, but I rather would put more faith on the CEOs and the people who are managing the infrastructure to come and tell us whether the chips are still useful. Can you still use it for 5 years, for 6 years, or these become paperweights after 2 years? Right? So this chart shows you how the depreciation expense has grown, and obviously because now we are spending more and more on the CapEx, the depreciation expense will grow, but Michael Burry thinks that it should grow even higher. And that's what one of his bubble thesis is. Meanwhile, we also saw more funding coming in, like Cursor raised additional $2.3 billion at almost $30 billion revenue. And Thinking Machines, a lab founded by Mira Murati, the ex-CTO of OpenAI, they don't even have a product, but now they're raising funds at a $50 billion valuation, right? So these are some signs of frothiness. We don't know, when exactly. Is the bubble still growing, or is it grown so big that it's going to burst? No one has any idea. But it pays to see what's happening in the market. So a lot of chatter around these insane funding rounds. Sometimes the funding is happening without any thinking or giving any thoughts to, are you ever going to make money? Is there any justification for this? Or it's right now just faith-based investing? We have to win this. It's like, I need these hundreds of billions of dollars or trillions of dollars to create God. Now you don't question, right? That how do you justify getting ROI on a God, right? Hey, if I can create a God, then any amount of spending is justified, right? So right now we are at that stage. If you ask Sam Altman for any justification, there is none. There is none. So there is no justification for $1.4 trillion, other than the fact that if you create a God, then there is no limit on how much money you can make. And then yesterday, while doing my evening walk, and you guys know I listen to Bloomberg podcast called Odd Lots. They sometimes invite some guests who are way more intelligent, and they had a interview with Paul Kedrowski. He's from MIT and also have been a VC, and I think right now he's a partner with some company. He talked about how AI is a meta bubble, pun intended. Lot of bubbles rolled into one. right? So if you're interested in to get into the deeper, listen to him, go and give it a listen. It was released yesterday on a Bloomberg podcast. I'll just give you a quick summary, right? Number one, right? It says it includes real estate bubble, because look at all the spending happening on data centers. Great tech story, AI, we're gonna change the world. Like we had the same story during 2000. Internet will change the world, which it will. AI will, but we went through the bubble cycle, and then we will lose credit, which we had in 2008. Or many of the bubbles are just fueled by a lot of credit floating around, and now we are looking at investments to private credit and SPVs, and now with the notion of a government backstop, because we are saying, oh, this is existential competition. So we talked about now this, I just basically asked I think Gemini to summarize for me after I listened to it, so that I can just present you with a summary. It says CapEx is like a Schrodinger cat, right? It could become a moat, or it could drag you down. Right? It's a moat because no new player can come in and start playing in this base LLM models, because you need to spend $50 billion in CapEx. No one has it, right? So it gives you moat. Sometimes the large amount of CapEx can be a strength to your company because it builds that moat. But it could be a weakness, and a horrible weakness, if you cannot get the gains or cannot see the returns to justify those big capex, right? Second thing, it is a credit story. Tech is shifting from an equity story to a credit story. This worries me a little bit, right? SPV loophole. Massively profitable companies like Meta is now using SPVs. Anyone remember the other big fiasco around SPVs? Come on, not that too old. Which other company blew up wherein investors did not know that they had a lot of losses or the
Signature.
debts? Sorry?
Signature?
No. It's not that new either. It was
Signature
Enron.
Bank?
No, it was Enron. So if you go into the history of Enron, the CFO of the Enron had another special vehicle SPV companies that he owned, and they basically moved all the bad assets to those companies. Now, what Meta has done, I'm not saying that is a fraud out here. Non-SPVs are all legal instruments. It is perfectly legal to do these things. The question I think the market asks is, why are they doing this? So Meta has now entered into an agreement with Blue Owl Capital, which is a private credit, big player in the private credit market, and created an SPV in which all the data center expenses will be borne by that special purpose vehicle. So all the debt, etc., will not come onto the Meta's balance sheet. So Meta has invested, I think, $3 billion. Meta has committed to invest $3 billion in that SPV. So the other question is, and this is how the Meta is going to keep its balance sheet little light. Right? Now, what we don't know is, if the bet doesn't work out, who's going to take the hit? If it works out, who's going to take the benefits? Right? How the transfer of the value will happen between SPV and Meta. So those are questions around it. So I think when we reviewed the Q2 report, one of the big reason why we think, hey, this time it is different from 2000 dot-com bubble is, these are cash flowing companies. They generate so much cash, they don't know what to do with the cash, and they can fund all these expenses. Right? That was a basic premise. We're saying, don't worry about these expenses. Don't worry. It's so, they can fund this. Like companies, they generate this $1 billion plus cash flow every year, right? They can fund these. Now that story has changed in last few weeks, after we have seen that many of these are actually going towards the debt market to raise funds. Why not using their cash? Are they little afraid that the cash will get tied up, that now they can't give the benefits? They can't buy back the shares or can't give the interest rate, etc. Possible, not possible. Again, I'm not saying either way around, right, whether it's right or wrong. Something to keep an eye on. This we have not seen before. Okay, let me come on 1 second. I see some annotations. Maybe. Okay. Then the third is a mismatch between the temporal mismatch between assets and the liabilities. Right. Remind me, this is like less than 5 years old. Which other company we saw that we blew up because they had a mismatch between the assets and the liabilities, the timing mismatch? And we talked about it. And market was like going crazy. I'm like, it doesn't make sense. And eventually it blew up. Which was other company where we have seen that they tied themselves into long-term debt, long-term liabilities, whereas they had a very short-term assets to fund those liabilities. The company that was more than 40
WeWork?
Exactly. Alan got it right. It was WeWork. And I think JP Morgan tried to take it to IPO at $42 billion. And when we're looking at the S1, you taking a mortgage for 15, 20 years and you're renting those facilities to startups, which will crash and burn in like less than a year. You are funding your long-term debt with the short-term assets. You always will be on the run, lookout for new companies to come and basically rent it out. Just doesn't make sense, right? Same now is a little bit of a similar thing we are seeing here in which the company is like Microsoft took a stake on like 3 Mile Island. The companies are taking stakes in investing in power generation plants, data centers, whichever lifespans are like power generation plants have a lifespan of 30 years. Okay. And we don't know how you generate money to fund that is you are basically taking your GPU as a collaterals and saying, these GPUs serve as a collateral to take those debts. GPU become not obsolete, but the value start to decrease. And so you have to always find a constant source to fund that. Little bit concerned. We have energy scarcity. I think Amazon had a data center they built up, but they couldn't even start it because there is no power available. So unless we fix the energy problem, all this data center build may not yield to much, right? And then of course we are looking at a securitization, right? So all these debt get securitized, sold over, then it's sold to the customers, etc. Those investors who buy it, they have no idea what an AI is. Similar to the case what we saw in 2008. The reason 2008, reverberated throughout the world was these housing loans were securitized in different tranches, and then they were sold to investors in US, investors outside. Banks held it on their portfolio, had no idea what they are holding. Similarly, now we are seeing similar story playing in AI, right? Third thing is talked about is the unit economics, which is negative, right? Every new query on the LLM, of course, maybe the LLM has to become, they have to scale it up so that it becomes a unit economic positive. But right now, the cost of serving the cost of a LLM actually is growing linearly or maybe sublinearly with how many queries are happening, right? At some point of a time, you have to reach a stage wherein any additional queries doesn't incur cost, right? That's where you will start to get your operating leverage. We're not there yet. Maybe we'll make it up on volume, right? Fragile justification. This is what I was talking about. It's a faith-based argumentation, like Sam Altman. There's no justification of $1.4 trillion. So he became very defensive. In some other cases, the CEOs will say, we have to win this war. We have to win this battle because if we don't, it's an existential threat for us. Don't ask me for any justification because I don't have any. Only justification is if someone else wins this, I'm out of business. Right? So that's a faith-based. Third is we have a boogeyman in China. Right? China's done much better. You basically use a distillation approach rather than focusing on base LLM models. You have a train the trainer, right? Much cheaper. And then the final is we talked about is, hey, what's the real future? Do we really need these big base models? Or probably gonna have instead of LLMs, we'll have a SLMs, small language models, and what are they being used for? It's a good. I found it really, I would say, thought provoking, because this gentleman was also he wrote a blog in 2008, had a very good analysis of what happened in 2008, right? So he's been around the block a few times, and he was able to explain it in a much lucid way than I've heard some of the other so-called Wall Street people explain what's happening in this area, right? So if we want to dig deeper, it's almost an hour-long podcast. So go ahead and look at it. Third is Michael Burry is now shutting down his fund. This fund was anyway, if you look at the latest 13F, as of September, it has like only $50 million AUM. So not a big fund. So sometimes I feel just because he came in fame in 2008, we actually paid a lot more attention to what he has to say than what we should. So, but anyway, on 20, he is now shutting down his fund and returning the capital back to fewer shareholders, because I think his sign management, it was converted into a family office kind. So he never had a huge outside investors anyway. And now I think he's like, what? I'm just gonna sit and tweet and not worry about managing money. So he's winding up his fund, which was anyway has been become a trickle of its original investments that used to have that. But what was interesting to me when I look at it was this address. I'm like, oh, that's not too far away. Maybe I should go and just visit his office. Uh, Hopefully, still have a signage and maybe take a picture with it before that goes away. Maybe I'll see if I can do that over the weekend. It's like a couple of miles away from my place, not too far away. All right, so that's all about the AI stuff. Let me, hear your thoughts. Anyone has to say anything? I see a lot of comments over there. I don't know if there are any unanswered questions. So if there are any unanswered questions you want to ask.
What is the Scion Asset Management? What are you showing? What is that?
This is the Michael Burry's fund that is now liquidating and is returning the capital. He's closing his fund.
Yeah, because he couldn't deliver good returns for his investors and they got fed up with him. So he has to return his capital.
I mean, he has only limited number of the overall, his fund is, like I said, he's only $50 million, very small of what it used to be, because he's been bearish for so long. And I think somewhere on Twitter, I shared a chart saying if you listen to Michael Burry, he told that the world is coming to an end and the bears are going to eat the market probably 10 times since 2008. So, but yeah, I mean,
my opinion is like he's a one-trick pony that's overdue to resign.
Yeah, I agree with you.
And unfortunately, we as an investors or the market as a whole give too much attention to these one-trick ponies. Every year we do this. 2021, it was a Cathy Wood. She became good on Tesla. And now we started like, oh, she is the goddess of investing. Her bet was on Tesla, which worked out very well. I don't think none of our other bets have worked out. But then we like, it's all Cathy Wood in 2021. Then we had a Tom Lee, right? Now Tom Lee's BMNR hasn't worked out. Tom Lee's IWM will be a 50%, hasn't worked out. But he was bullish in 2023 and market was up 2020. He was one of a few Wall Street managers was bullish in 2023 and it worked out for him. Mike Wilson was bearish and we started like worshipping Mike Wilson, and then 2023, 2024 never worked out for him. So you're right, Alan. Unfortunately, it's up to us. Who do we give our attention to? Right? Not to these who have been successful once in a while. But these guys generate headlines, and that is why they are always on CNBCs, and the Bloomberg will report these stuff than anything else. Because hey, they need eyeballs. Asif says, Satya Nadella explained on recent podcast, GPUs are not decommissioned. Yeah, I think I heard other ones also. There was a guy who manages AWS infrastructure. He was in some investment conference, so he was also explaining similar thing. So Michael Burry probably doesn't know how data center works, right? So don't go exactly by what Michael Burry is saying. What else before we jump onto maybe the box spread strategy? Okay, Alan say, hey, buying OpenAI in private market $500 billion for 1 trillion IPO is a good enough reason. Yeah, probably that might be the first company to get to $1 trillion IPO. I mean, Sam had sneaked in a figure of $100 billion during B2G podcast in 2027. So if you have $100 billion, and let me take him as a face value. If you have $100 billion of a revenue, 10 times sales for a company that's going to change the world is not huge. So it's perfectly possible that $100 billion revenue, they come IPO and they're valued at $1 trillion. That's a decent valuation. Not super expensive. But the question is $100 billion workable? And number two is, yeah, your revenue is workable. Are you ever going to make money on that? I think these are the two important questions. So far, based on the recent funding, we know that they made $13 billion. Maybe in 2025, let's say they make $26 billion, $30 billion, right? And the bigger question will be around the unit economics and at what point of a time can you actually convert it into making profits as well. Ask this question, any thoughts on VMA getting close to 52 weeks low? I didn't even notice that they are 52 weeks low. Is it correction just in anticipation lower rates? Seems like a good time to buy. We'll look into which are the top companies that managers have bought. I think we showed up as a topmost company. Okay, think of them right now. So, but I think both Visa and MasterCard have a strong moat. Only thing that we should look into is, hey, these rise of stable coins and can they disrupt their business model. But Visa recently started a pilot. I think this week there was a news on allowing the merchants to basically use stablecoin rails to do much quicker settlement and all that. At the end of the day, at these stablecoin rails, etc., are going to be all in the back end, right? Whether you're going to use ACH rails, whether you're going to use those debit card rails, what payment rails you use is all back office work. And if Visa are going to switch over to using stable coins as a rail, sure, then they will ride this way. MasterCard has got a lot of patents on the crypto technology. So they've been watching this space for 3-4 years. That they have not been sleeping. They've been watching this space, and if they thrive in the space, great. They've got a huge moat built around the business, a huge network value, which through that these companies continue to generate decent business. Are they huge growth companies? Probably not, right? But these are very stable, could be a part of a stable part of portfolio if you don't hold any other payments company. Okay, Mike has a lot of comments, so I'll skip that one. Maybe the movie made more money. I think that was for Big Shot. How do you know what should be the value of AI comparison like Palantir? No one knows. Right now, that's what based on faith in terms of are you ever going to make money? But some part of a time, I could say that if Palantir is trading at 100 times sales, right, it means we are pricing in that. I've never seen any other company so overvalued. Let me put it that way, right? So it means for next 100 years, if they continue to do the same sales and have a zero expenses, I'm paying that much for Palantir. Sure, it can continue to grow 30%, 40% year over year. You bake that in. Still, for me, it is too expensive, right? A lot of these AI companies are overvalued, but are they overpriced? That's a different question. Overpriced, so because market would continuously price it higher. So if I think it is overpriced, I could be wrong. Market might think, oh, you know what? There is no other way to put this money. I'm gonna still buy Palantir. Go ahead and buy it. Right? I think even some of these companies, I don't think like Amazon is not overvalued, but some of the other tech companies are overvalued. But it may not be overpriced just yet. When all the companies become overpriced, when market realize that it overpriced, that's where we get a catalyst for bubble to burst. And no one knows where the market is gonna price these securities. So it's very, very difficult. So that's why I'm not selling off. I mean, I still hold a couple of some Palantir shares, some portion still there, keep selling covered calls on it. And this week, those covered calls printed some decent amount of money, and I still have on it, right? And if it gets called away, I'll have no regrets. At some point of a time, I have to start preparing for next year and to raise cash. Since I don't have a W2 income, I have to figure out which ones to raise cash from. Palantir is right there, right? They are super, super expensive. Mike says balance the valuation PE. I'm not looking at PE because when I look at tech companies, looking at a PE doesn't do justice to them because of the accounting rules. Even look at all other metrics on a Palantir. Every other metric Palantir is so overvalued, right? And I'm ready to pay for such a great business if it's actually a great business. 17 years in making and your margin are still like mid-teens. If you're really a software company, show me the margins of software company. I haven't seen that yet. Alex Karp will talk a lot about it. I've been listening. I don't know. Mike, I've been in Palantir for now 4 years, right? It's a great buy at $7, decent buy at $26, $30, horrible buy at $175. So at some point of a time, I have to make a decision, which is 175 not for me. Jose says the issue is stablecoin lower the cost of transaction. Oh, okay, I think we already talked about it. All right, so I'll skip a lot of comments are there. Let me move forward. If there is something that you need to ask, maybe raise your hand. I'll invite you to ask a question. All right, let's talk about maybe a refresh on the box spread. Shall we do it? Anyone interested in it? So basically, because the markets were down, I had a couple of puts that got assigned. I think last week also and this week also I had a put got assigned to me. And my brokerage, I ran out of cash. So when your cash becomes negative, basically you're borrowing the money from your brokerage and you pay that margin interest. Charles Schwab, I don't know how is it even legal that it's like a criminal. They charge like 12% interest on the margin on any cash that you borrow from them. I don't want to pay 12%. So what my vehicle has been is to basically use box spread option strategy to raise money at, I think this time I got at 4.2%, 4.4%, right? APR, which is almost close to what Treasury would pay. A little higher than that, but much better than taking personal loan, much better than your credit card loans, and much, much better than your 12% margin loan. I know Interactive Brokers probably has a better rates, but I have an account with Schwab and I was account with a Thinkorswim, TD Ameritrade. Now I'm a customer of Schwab. I'm stuck with that. I've not yet decided to change because it's not that very often I have to raise cash on margin. But this week I did. So I went to the same playbook on do a box strategy to raise 20K at 4.38%, right? So I tweeted about it. Let me just give you the numbers, what the numbers were exactly, right? So how to borrow at 2/3 of your margin rate. So this is what I did. And I'll show you the structure of the trade. Basically, it expires 370 days later. I did it yesterday. It expires on 20th November, 370 days. At 370 days, I'll have to pay 20K to close the trade. But today, I received 19.15K, which turns out to be, if you run the math, it turns out to be 4.38% APR instead of a regular margin rate of 12% at Schwab. So then, and now I'm thinking if the portfolio is decent enough to hold this trade, which mine is, I am generally conservative. I don't use all of the buying power that portfolio provides, so I can do this trade. Now I'm thinking maybe if I have to buy a car, which probably I'll be in the market to buy a new car, new or the pre-owned, whatever. Why should I pay 6% auto loan on 7% auto loan? Maybe I'll do this box spread and raise cash at 4-5% and use that to pay to instead of taking a loan on from an auto company, or flip it around. If I need to pay for let's say mortgage or something, can I raise money using the box spread and not having to borrow more at 7% rate, right? So there are a lot of financial advisors use this for their clients who have, let's say, $1 million, $2 million, $5 million of portfolio. They have enough of buying power and they want to buy a house. They need to raise 200K, 300K. The financial advisor, those who understand, those are real good in terms of managing money, they'll tell you, hey, don't tap your mortgage market. We will raise it for you using this strategy at much cheaper rate. Now there is a question Mike is asking, what's the downside? So downside is this, it will block that much of an amount from your brokerage buying power, right? So now let's say I raise 20,000. If I were to do some trades on my account, then I will 20,000 less buying power to do those trades, right? But I'm okay. I'm not consuming my buying power anyway, right? So I can do it. Number two, it might require a higher privilege on your option trading levels because you are actually doing spreads. And since you are doing spreads, like you are also selling option in this case, you're basically buying one, selling another one. It's a combination of two different strike prices. So you need to have that privilege to do it. Number three, you need to pick up the right ticker to do it. Don't pick up the tickers that can be assigned. So that's why. And I covered this in one of our previous sessions. So I think so yeah, I looked at in this tweet, I actually gave you the link to the YouTube and the timestamp. So if you're really interested on this, you can go through that. You can go through this message and look at the timestamp in terms of how to create it, which tickers to pick up, what's the drawback, what's the downside of it, what's an advantage of it, right? So there is always a trade-off, but I like my trade-offs here, right? So if I like my trade-offs, I'm gonna do it. I understand what the risk is, and yeah, I won't be able to invest that $20,000 in any other script in the market, which I'm okay with it, right? Now, the brokerage firm will never tell you if you call up the customer support and say, you know what, I'm a negative on cash. Is there any better way? They will never tell you, because why would Schwab representative tell me to do box spread and give away 12% margin interest? They won't do that, right? So now if you want to look at the structure of it, and hopefully if the Thinkorswim is working now, no. Okay.
I'm just curious, how much do they pay on idle cash if they're taking 12% on margin?
They'll pay you zero, right? I know there's a rhetorical question. They'll pay you zero unless you and that's why I use ICSH. Every time if I have an idle cash, I will move to ICSH, at least get that 4% yield. Right? These brokerage firms are not your friends. They are out there to look for themselves. So you have to figure out what to do with my idle cash. Move it to money market your funds. Like I use ICSH, which is money market plus a little bit of a corporate, and that gives you like 4% plus. So, but if I don't have fund, and then I'll use a box to just raise that fund, right? Because I was negative on cash. So this is the structure of box, but at a high level, you know, it is consists of two legs. Number one is that because I'm raising the money, I do not want to have any exposure to the market or to the underlying ticker movement. Right? I don't want to raise money and then I realize, okay, SPX has gone low and I lost money because SPX has gone low. Right? Or if XP has gone high and I lost money because SPX has gone high or it has moved. So it has to be zero. It has to be no impact by SPX movement. Number one. So it means it has to be a zero delta trade. It has got, once you entered into the trade, after that, it doesn't matter where SPX goes. Because Tom Lee says that it probably will go to 7,000 by end of this year. And if we listen to Jeremy Grantham, it's an opposite. Oh, the market will crash 30%. Right? So, but I don't want any exposure, any risk because of the market movement. So you have to have a zero delta. Zero delta means if you bought a bullish leg, you have to have a bearish leg of same delta to nullify it. So it has got two legs. One, I call it as a synthetic long stock position. Means, hey, I got 100 shares, which I'm long, but I'm not going to buy the shares. I'm going to create a synthetic long position using options. And the way you do it is you get a long on a call, means you buy a call, which is bullish, BUY. Buy a call, which is bullish, and you short a put, which is also bullish. You do both on the same strike price, this give you 100 deltas trade, right? Right now, with this trade, I have a positive 100 deltas in my portfolio. Next trade we do is synthetic short stock, right? Basically, which is opposite. If I'm gonna short the market, what I'm gonna do? I'm gonna buy what Michael Burry bought. He wanted to short Palantir. What did he buy? Come on.
Puts.
Puts. So you buy put. What I do if I want to get a little bearish on the market, I've been telling, right? I sell calls against QQQ. Or you short or sell calls. Right? Again, you do it on the both are on the same strike price, so you get negative 100 deltas trade. So when you combine both of them, you have a net zero delta trade. It means, and doesn't matter if SPX move anywhere, you will not have any delta. So let's plot this. So this is what the basic structure of the trade would be. No strangle. All right. So right now I'm sitting here, SPX is here, right? If I were to close this trade, I told you, right, I have to pay 20K, means my cost of this is almost $850, right? Doesn't matter where SPX goes. SPX can come down to 2,000. Right now it's sitting at 6,700. It can come down to 2,000. I'm not losing more than $8,500. Still, it's, if you look at this, 850 is what I will lose, or this is the cost of doing this, which is what converts to 4.38 APY. Doesn't matter where SPX goes. So that is why, and you have to create a zero delta trade. So there is no risk or no impact of SPX moving up or down because I have a zero delta trade. So right now it's showing like -0.75 because, you know, these strikes I picked up, not exactly, but you get the point. You can plot it and see where a P&L diagram doesn't change. at an expiration. In between, it could go anywhere, and I don't care where it goes in between. Right? So zero delta. Now, you could do this box spread on any ticker, because at the end of the day, it is nothing but you're buying and selling some option legs, right? Nothing more than that. So what I did was I went to this November, right? I picked up this strike price, which was like close to at the money. I could have tried on any other strike price. Let's try on maybe other strike price. Let's start with, let's go down 6,600. So this is what the put side, sell put, buy call. So if you do this, I've got 101 delta, right? Close to 100 deltas. Oops, where did I go? And then let me go back and say 500. I did $20 white, right? Don't have any $20. Let's do $50. Do the reverse of it. Buy put and sell call. So this is and now if you analyze this, you got almost zero delta trade. Now this at a end of expiration, November 26, which is 369 days out, will close at $50. I have to pay it's $50 wide, right? 600, 6550. Yeah, so that will be, you have to pay $5,000, $5,000 for it. And for right now, I'm gonna get for $4,795. So you can back out your math saying you are basically paying $205 for borrowing 4,795 right now for 370 days. What's your APR turns out to be? So when I did those calculation on this one, my APR turns out to be 4.38. Right? And again, you can now, if you look at it, there's the new one that we constructed is 205 is what you need to pay. Doesn't matter where SPX goes. So you have to pick a ticker in which you don't get early assignment. Now SPX, NDX, you don't get early assignment on this one. So, and that's what I explained in that video. And I know on Slack, somebody asked on it, how to create this. This is how you create a delta neutral, pick up the right ticker, and try a few one. I tried a few strike prices, but eventually I don't think there was much of a difference between what I was getting, and then I just had to change the pricing a few times to get a fill, and finally I got filled at $191.50. I was trying to get $192, but never got filled on it. So then started reducing 10 cents, and eventually got filled at $191.50. So that's it. Now let's say if my cover call get assigned, etc., and I have a cash coming in, I will see when I'm closing it. Obviously, I don't have to pay $200 because here I'm closing it much sooner before expiration, but I will see at what price point I'm offering me, and then I'll see if I borrowed for, let's say, 3 months, 4 months, and I close it after 4 months, how much eventually did I pay for it and what's the APR. But I think rather than taking auto loan or maybe taking a margin, I find this is much better way of raising cash. So I thought I'll discuss this again in today's meeting. Useful. Let me see some questions. Selling ICSA to raise cash. Do you pay margin for? Yeah, but I mean, you can sell your ICSH, but then it's T+1 settlement now. We moved to T+1 from T+2. Even my money is blocked against selling put sell trade. Yes. So your money get blocked. That's all. I mean, in this case, 20,000 get blocked because they're $200 widespread, and it's okay for me. I can afford. Do you have a widespread when you close it? So at the end of the day, on expiration, we will never trade bill more than, let's say, $200. And since it is a it's a cash settlement. Let's say the SPX is at, pick any point, right? 7,500 by November mid. I don't have to do anything because this SPX is a cash settled instrument. Only thing is it will automatically settle, and the net effect will be $20,000 will move out of my account. So I just have to make sure that I have a cash at that $25,000, or otherwise I'll do another box spread, right? And raise it at whatever the current price will be at that point of a time. So I found it useful. Now this is my second time doing it in 2025. Can you make an interest on the money you get? You use $20,000 for whatever you want to. You can find better opportunity than the reason why I did this was I want to hold the stock. I don't want to sell those stocks now because the markets were down. I got a sign. I'm like, I think 4.4% ABR to hold the stock is okay. I'm okay with it. And that's why I did it. Otherwise, I could just sell the stock that got assigned and raise cash. Can you give a Grab holdings? So give me the market cap of Grab. Give me who the CEO of Grab is. And third thing, and now which I will ask you is give me their latest, let's say, what's their revenue is, what their EPS is, and how it changed year over year. Then I'll give a deep dive. I added the third one. I need to refine on the third ask before I do a deep dive. What do you do that the money is blocked? Let's say when you are, let's say you have, and I think you need to have a margin account, which I have with Charles Schwab. So if you're trading options and you have more than $25,000, they'll give you margin account. Let's say if you have a margin account and you brought in $100,000 of cash with them, right? If you're trading stocks, you'll be able to get a 50% margin. You can actually buy $200,000 worth of stocks by using $100,000 cash. Let's say, but let's say you did this option trade, the box spread. Now 20,000 that will get blocked. Now you have only 80,000 that you can play with. That's what I mean when I say the money get blocked. I cannot buy more, other stocks because the 20,000 is reserved for this one. Brokerage will set that aside. So can you buy a share with it? Yeah, cash come in your account, then you do whatever you want to do. I'm not a big fan of always buying shares on margin, but in some cases, yeah, especially especially in my case where I don't have a W2 income, right? So I have to find a ways to generate some funds. All right, looking at a sector wise. This is why I was saying, markets are okay, guys. We are up 14.5%. So nothing to complain about the markets. And if you are in information tech, you're like 24-25% up. All sectors are green for this year. Stock buy sells this week. So this week I got Doximity, which is what I got assigned at 65, and I'm okay to hold it because I'm just refilling the tank. In September, a covered call was assigned at 70. So I let those shares got called away. I thought it was expensive. And then I started selling puts against it. Now the short put got assigned at 65. I'll hold it as sell covered call against it. Why? Because I recently, Doximity also had the results out. Revenue is growing 23%, which was a beat. EPS growing 40%. what I like about this company, it's a startup company, not a startup, but it's a smaller company, but it's been a very well run business in terms of cash flow positive business, been buying back the shares, even though it's to $800 million revenue company. What I didn't like was the stock-based compensations were higher, and buyback is still helping in terms of a dilution. But I think small portion of portfolio, and I will continue to hold it. Free cash flows was like up 37%. Net retention revenue 118%. They also came up with this docs GPT, and I've held this share for a few years. I talked about it, review it, and I still want to hold it after I got a sign, right? So that's why I said, okay, I don't want to sell it. Let me also raise some cash. Mike is saying, no, your 20K will cash come in the box spread trade, so the money is locked for 1 year. Oh, so I think, Mike, yeah, you're right. If you have to have the other portfolio to support this box trade, right? So that's what I meant to say. Your 20K, the width of a box, that will be blocked, right? But then whatever other stuff that you have in your portfolio is still holding it. You can still do whatever you want to do. Right? So cash will not be blocked. So for example, now I got whatever 20K cash. I can spend that 10K cash because I have the rest of the portfolio supporting that 20K of buying power. What did I sell this week? None. When I talk about these things, these are no recommendations. I just want to be transparent in terms of my stock holdings when I buy or sell. I'll tell you, and I'll tell you what I hold in my portfolio, top 15 at the end of a month. All right, looking at the crypto market, right? Not a good scene. Bitcoin is now below 100K after many weeks. So who knows what's next? We don't know where the support is or those typical lines of support and resistance. I think JP Morgan came up with and say, oh, what 94 is the lowest, and we think it'll go to 170. Who knows, right? Where it will go. But it did break through the so-called support level, because over the past many months of 100K, which was like a mental level, a lot of crypto investors / traders hope that it will never go below 100K. Here it is. It is now below 100K. So if you wanted to invest in this and thought, oh, 100K is too big a price, train is back on the station. Train always comes back, right? And other thing I want to talk about is MicroStrategy. I know a lot of retail investors get crazy on this. They think it's a leverage play on Bitcoin. But if it's a leverage play, Bitcoin is like barely at the same level where it was at the start of a year. So let me look at that. Let's go to CoinGecko and see. Situation could have changed. Look at BTC. Look at, okay, one is like, where's the YTD? I can't get a YTD here. Dang it. It was up 5.5%. So I think if I look at YTD / BTC, look at YTD futures. Chart doesn't show. Yesterday I looked at it, right? It is like almost on par where it started. So no profit, no loss, like 0.5% up, right? And MSTR is down like 33%. So it doesn't look to be a leverage play, look to be an inverse leverage to me, right? You need to understand what you're buying. So I never bought MSTR. If I want exposure directly to Bitcoin price movements, I can just buy ETF. I don't want to add another layer of a corporate, either, financial engineering, which these guys are doing. Maybe they'll do great. It's not fraud. I just not comfortable with that. All I want is a direct exposure. And ETF is a good enough way to get that exposure. Right? A T-bill higher return than Bitcoin white ETF. Absolutely. Right. And I see Peter Schiff now all over the Twitter saying, oh, you see, gold is up so much percent over last 2 years and Bitcoin has not. Come on. I'm not investing in this for a year. Or call it investing, speculating, whatever. It's not for a year. It's a decade-long experiment, at least. So if you don't have that much of a stomach, stay away. Right. And over the decade long, so far, I think it has done much, much better than SPY and gold and any other stuff. Will it continue to do in future? Who knows, right? But it's not a short-term play. What we also saw is none other ETF is now trading. XRP Army. Anyone member of XRP Army here? So now we have an ETF available for XRP. You don't have to really go and buy XRP token on crypto exchanges. If you want to play in this altcoin space. So last week I talked about Solana ETF is available. This week we got XRP. Maybe we'll get, looking at this administration, I won't be shocked if we get a Dogecoin and Shiba Inu Millennia ETF. This administration is like Wild West. Do whatever you want to, right? Buyer beware. And absolutely, it has to be buyer beware. You don't have a choice to say, Wall Street screwed me, this investor screwed me, Michael Burry screwed me, or whatever. Kathy Wood screwed me. Come on. Be responsible, put on big boy pants, and take responsibility of your actions. If you have always invested in T-bills, don't complain. Come on, I can't even beat inflation. It's your decision. Nothing right or wrong. Just it's always trade-offs. So decide what trade-off you want. Mike is saying Bitcoin versus gold. Gold of 50% YTD. Are they Bitcoin believers here? Yeah, I'm hopeful. But like I said, right, Mike, for me, it was a minimum 10, 15 year play. Right? I've not even reached halfway of my path. And then at the end of the day, it's a position sizing. Right? If it is not 50% of a portfolio, and I don't want to go all in, right? I never will do all in. I'll never go all in on myself. Right? So it's all, at the end of the day, it's all position sizing. Jose is saying no crying in casino. Yep, no crying in casino. All right. Last 15 minutes, we'll quickly go through some earnings and 13F insights, super investor moves, and then we'll get into breakout rooms. Any other topic that you guys have in mind? Anything else that caught your attention? I'm tired. Let me sip some water. No?
I've seen some moves by sovereign funds. Yesterday or today, the Saudi public investment fund divested from all its American investments except like 6 investments, which is like a huge move for it. So are they seeing something? I'm not sure.
I know SoftBank sold its stake in Nvidia. PIF, that's their sovereign fund, right?
Yeah, the Saudi sovereign fund. They
Yeah,
were always positive about the U.S. market, but I don't know what changed.
it doesn't show up in the news. Flashes Q3 stakes keeps Uber. Okay, maybe. Oh, because the 13F came out, and that's why you're saying I don't see any other news as of yesterday. Saudi Arabia unloading most of stock holding Q3, holding on to Uber, Lucid, EA, Take Two. What they exited was AMD, Amazon, Apple, Bank of America, blah blah blah. Yeah, so their 13F filing came out. Damn it, I don't track Saudi PF. Let me take a note of this. For 13F, maybe from next quarter, I'll start also adding tracking PIF. I mean, I don't know what their reasons are, because maybe they need a lot of a cash to. Haven't they invested in OpenAI or something? They also need a lot of
Nope.
cash to build their data centers, etc. And I know that SoftBank sold OpenAI stake, sorry, Nvidia stake, because they need to fund OpenAI. So we'll never know why they are doing what they have done. And okay, maybe I'll read that later. What else?
I mean,
Let's
it
look
might
at.
be just me, but I've been doing a kind of a deep dive into Saudi moves, and I've found not just that the PIF has been divested, but also that the oil market has been looking kind of promising, especially that there's no more investments into oil in the US, but Aramco is doing pretty well, and it's being sold at a pretty discounted value. So have you ever looked at that or looked at the
I've never
oil
invested.
markets?
No, I'm not a macro trader, so only when I do have some XLE in my portfolio. That's just because I want to have a little bit of a diversification. But I'm not a. All I heard was that there is a glut in the supply, and that's why the oil prices were down. I think I read some headlines somewhere. So I'm a little surprised to see that you are saying oil prices were actually heading higher. Maybe if it's a China story, that could be different. But somewhere I read that we have a glut in the supply. But anyway,
I
I
heard a
don't.
lot of
Sorry, go ahead.
yeah. I heard like you about the glut, but I understood that China was using a lot of its inventories. That's why it seems like the demand is not as high as it seems. And IEA kind of projected that the oil demand is going to peak around 2030 or 2040, but now they changed that completely and expected it to kind of really grow even after 2040. So the whole kind of view around the oil market has really shifted. Now the underinvestment into oil is kind of looked down as like, oh, now we kind of, we thought it's going to peak the demand of oil, but now it's not going to peak. Maybe we made a huge mistake, and now we should really act. And
We
the
should.
only actor today is Aramco. So
Yeah.
that's why I kind of looked at it that way.
Yeah. Oh, and I think I've been hearing about this for almost 2 years around the commodity super cycle will start because of all the under investments that have been done under the pretext of hey, green economy, and then as you rightly said, no new wells were created, no more boring and all that stuff. And now if we start to get that super cycle, but I've been hearing for almost 2 years. Lynn Alden used to talk a lot about it in 2023, 2022. But again, I'm not a macro investor. I just don't, and there are some who will focus on energy and materials and commodities. I'm not big, but I do want to have exposure to energy, and my vehicle is XLE. I own a little bit of it, and I always have some options. So right now I have a strangle on it. So if it falls down, I will buy it, right? And if it goes up, I'll sell a little bit of it and then sell another strangle. That's all. I try to keep it life very simple. I don't understand the the ins and out of this sector, and so then I'll stay with the ETF. All right. Let's do you want to go through earnings, or shall we look at 13F? Let me ask you, any holders of Jumia Technologies? I'll go through earnings if any one of you own these companies. No, I'll skip it. How about C Limited? Any C Limited? No, no. I'm waiting if there even anyone who says yes. All right, you saved me then few minutes. I'll skip these two. Lilia says I sold C Limited. What was the reason? Okay, I saw a couple of folks who are saying they hold Jumia, so let's go through it. Lilia, I want to share a reason why you sold. What did you see in the company? You sold a 192. So right now, hopefully, maybe you should buy it back because now it's, I think, close to 140 or something. Right? If we look at a C Limited, yeah, 140.85. All right, so let's go through C Limited. Let's go through both because I see a couple of them saying. So looking at Jumia Technologies, right? Again, this company been following it for 5 years now. Have gone through many cycles of ups and downs. It was like some point of a time it was like $60 stock, or maybe close, not 60, maybe 40 or somewhere. And then at other point of time, it was also a $2 stock. Again, as an investor, you want to focus on the business more. And when I look at a $2 stock and I'm like, business is not that bad, but market is like giving it for that. You load up on it, right? You add more on it. So this basically those who don't know about this company, this company is basically building an e-commerce infrastructure in Africa. They used to operate in almost 13 countries. Now they have whittled it down to 5 countries because after 2022, every e-commerce company was okay. Growth had reasonable prices, and that's what this company also went through the whole transformation, fired the co-CEOs, and then brought in promoted someone else as a CEO who last 2 years have been focused on profitability plus growth, right? Not just growth, but growth plus profitability. So you would have seen their revenue came down in some quarter, market puked on it, but they wanted to grow into the areas where they can actually see a profitability down the line. Continue on the same path. Recently, they gave a guidance that we want to have a goal of EBITDA break even by 2026 Q4 and full year profitability by 2027. No difference in the strategy change. But over the last 5 years, I've seen them changing strategy 6 times. And I track every those. I'm like, okay, what did they do this time? No change this time. Revenue up 25%, margin was slightly down, and we'll see why the margin was down. And overall, all the metrics look good except the number of transactions. So they also own a payment company called Jumia Pay, in which basically the customers either, and Africa is very different than the developed markets, right? You don't even have a standard way of writing the addresses, and then people don't want to pay using the cards online. Maybe they want a cash on delivery, etc. So very different. Amazon tried to do the business there, haven't been able to compete it. This is like a 20-year long investment horizon. So when I got into this, I think it was 2020, 2019. My holding, at least I have to hold it at least for 20 years because it will take that much of a time to know if e-commerce will be successful in America or not. So right now I'm my 6th year, long way to go, right? So transactions were down. So first I got spooked out why the transactions were down, but then I looked into the details of it. I realized why the transactions were down because they moved the focus from just doing a low value digital transactions to high value physical goods. So even though you will see the overall revenue was up, GMV was up, the number of transactions were down. So yeah, it's okay, right? They also enjoyed 300 bips in the revenue from a currency exchange, which because it operates outside of a US. Any company that you hold in your portfolio that operates outside of a US should look at what's the impact of the currency exchange was, right? Good growth, good usage, demand continue to grow. They've been very efficient in terms of cutting down their cost. And in some quarters, we saw that they have actually reduced their operating expenses by 50%, which is huge. right? And then the headcount, continue to maintain the headcount discipline. So overall, I think I am still continue to stay bullish. Management has been executing on the path that they told they will be. So I have no reason to punish the company, right? So then I talked about why the number of transactions went down. So if you are more interested to look into the details, you can just follow it on Twitter to get through the details. Third thing, which I find interesting is, and I remember like 2 years ago, you jump into the earnings call, not even single analyst. Wall Street talked about it, CNBC talked about it in 2021 because that's what they want to do when the company is in news, when the retail investors are interested in it. They will talk about it. Some of these so-called Wall Street pundits, the whole group of they come on halftime traders report, right? The bunch of folks will come in. I even forgot the names of those guys. Guy Adani, who else are there, right? Liz Young. So one of them, the guy who runs the short hills, like he actually bought Jumia and he talked about it. Oh, this is a great company. This is going to be next Amazon and all that because the stock was going higher. And when the stock started to trend lower, he never talked about it and told, you know what, I took a loss and sold it off. So when he sold it off, I mean, that was the best time to buy because the business is still improving. So, and I will continue to hold it. It's above my cost basis. So, and I've been selling options against it. Pretty happy so far. If the management pivots and do something stupid, that's when I'll become bearish. Stock price goes down, maybe I'll buy a little bit more. But so far, so good. Any questions on Jumia? Otherwise, we'll jump on to C Limited. Yeah, last thing I brought up the topic of analyst. So zero analyst in 2022 and even in 2023 Q4, I saw one analyst jumping into the call. I will dial into the call. I'm not an analyst anyway. And then of RBC, this quarter, we had a 3 analysts covering it, right? So hopefully the traditional Wall Street will become interested in it and that will just probably enjoy better multiples. We'll see. Any questions? Otherwise, let's go to C Limited. So C Limited, they reported the results, nothing to complain about. Revenue up like 38%. Net income was down, but it's okay, right? Net income was down because one of their investment didn't work well, but nothing to do with an operations, right? So unfortunately, after the SEC had changed the rule, you always have to look for net income impact, either positive or negative. Is it coming through the business or is it coming through their investments? In this case, the net income missed the estimate because one of their investments didn't do well. But from a business perspective, they still did okay. So don't pay too much attention on net income and EPS. All the sectors were doing great. So basically, C Limited got 3 sectors: e-commerce, then money. So e-commerce, they call it Shopee. Then they have a financial services, which they call is Money. Then they have a gaming sector, which they call is Garena. This company is largely focused on Southeast Asia, like Philippines. It's based out of Singapore. It's active in Philippines, Indonesia, Malaysia, now more recently to Taiwan, etc. Right. So the margins were down. Sorry, not the net income, but if you look at the margin was slightly down, right? And that was also because of they were investing in their fulfillment infrastructure, which as an e-commerce company you should. Second thing is they had a huge growth in the VIP program. Lot more of this is like an Amazon Prime. They have a Shopee VIP. If you become you upgrade your membership to a VIP program, you get some free benefits, right? Like free shipping, etc. So they lost shipping revenue as compared to previous quarter, which was because a lot of they saw growth of 75% quarter over quarter on their VIP program, right? So which means you're not going to make that much margin, but you have a much bigger, higher revenue, because these, just like Amazon Prime, if you're a member of Amazon Prime, you tend to buy more. They're seeing that your VIP member, they're actually spending 40% more on the platform than they were doing earlier. So I'm okay with it, right? They're increasing their GMV, they're increasing their take rate, and margins is impacting because of this investment, and the growth is still fine. So market did not like it. Market punished the stock, so I thought maybe I'll sell a put spread. So right now I have a put spread on this to buy a stock more if it falls down. That's a couple of earnings, guys. Any questions on C Limited? Questions. I think Michael asked a question: how can someone start investing low amount of money? I think Asif has got a very Asif has the best answer. So let me thumbs up it. Start with index fund. Like that's how I started my life when I started in US. I think I started with 7 ETFs before I started looking at, okay, let me now look into individual stocks and all that stuff. So Michael, this is what I do for my kid. Her 401k just goes into, I think, three ETFs. I told her, don't try to try to complicate it. You don't have a time to follow individual companies. And basically I helped her set up her 401k with her employer where it choose her investment. I said, just pick these three, or maybe it's three or four, right? And let it compound. Like she got 40 years of compounding in front of her. You don't have to do anything new. So start there. SPY, I think Asif has given some takers, but start with a base index ETF, no very low fee, and that's until you get educated about individual stocks. Right? Stay away from these hot tips and don't try to time the market. All right, let's look at 13Fs then. Let me sip some water. Any other questions? And Michael, make sure that you don't need money to pay your bills. You don't need that money for at least 3 years. The money that you're putting in the market. Have your emergency fund ready. I actually covered 101 of investing, how to start, very basic, in one of earlier discussion. Ping me on a meetup. I'll send you the link to those YouTube videos with a timestamp on, so that you can watch. Like there are some pre-homework you need to do before even you talk about investing. Make sure you have done your homework on the personal finance management. And then make sure you have enough of base setup before you talk about investing in the stocks or in the market. But I've covered that in those discussions. Send me a message on Meetup. I'll give you the links. All right, so let's look at 13F. I still have to go through a few more themes, but these are the, I think even today morning I posted some more. Look at, let's say, 13Fs. The way I want to look at 13Fs is not individual. You know what Warren Buffett sold, but I want to look at across what's happening. So this I'm looking at is MAC 7 or LAC 7. I also covered the theme in Q2, which means I look at from different angles, right? How many dollars have been committed? I've excluded Tesla because generally, except one or two fund managers, not many of them are in Tesla. Kathy Wood is, Ron Barron is. Other than that, I don't see many. Right? So look at, focus on these six. Max 6 are still the top dollars, right? $71 billion. And this is across 89 funds data that I've consolidated, is in Apple. Right? I don't think it's like a new commitment in Apple, but hey, if you're a fund manager and you did not have Apple in your portfolio in last 10 years, what kind of a fund manager are you, right? So I think that investment that they have had is still continue to grow in value. So Apple, Microsoft, Alphabet, Amazon, Meta. You have a 5 of top 6 NVIDIA was there in Q2. NVIDIA dropped off, right? So now we see Visa is there, and then Moody's. These are the top 10 among 89 fund managers. Breadth of holders, right? How many funds actually hold these companies? Now, Apple, you got only 23 funds who have exposure to Apple. Alphabet, you got a 74 funds who have exposure to Alphabet. Much bigger breadth, right? And if we look at a breadth of holders, we got a Max Alphabet, Microsoft, Meta, Amazon. Top 4 slots go to these Max 6. Then you have NVIDIA, and then you have Apple. Tell me, maybe NVIDIA is number 11 because it got $21 billion, 375. Probably it's right after Moody's, right? And then you got Apple as well. So these are still one of the widely owned tickers, right? Ongoing conviction. Not only they command top dollars, not only these are the consensus holdings, there is also on the leaderboard of stocks added by most funds. 15 funds added to their Alphabet positions. One of them will be Berkshire Hathaway, right? Or either they initiated a new position or they already held Alphabet and they added more to Alphabet. Microsoft, Meta, NVIDIA, then you have Pfizer. Nothing except Pfizer, nothing surprises me. Last quarter, UNH was surprising because UNH fell down after the CEO of a United Health Insurance was killed, and then the stock was also not doing great. And I think fund managers probably bought positions in this. Now Pfizer, 11 funds added or initiated a new position in Pfizer. Maybe later on during the breakout room, we can get into the details of this, of around individual companies. But if you look at Pfizer, they didn't have a great year, right? Now, I think the stock got punished only after, so here. So after July, it has a huge drawdown. Sorry, Pfizer will be FI, not FIS. Yeah. Oh, okay. So even the Wall Street. So those who bought Pfizer maybe after this drop realize that the stock can further drop. So this is as of end of September. They might have exited it after, before these earnings. Who knows? We'll only get to know next quarter how many of them still hold Pfizer. Right? Then I looked at what are the additional dollars, not just amount of number of funds, but the dollar amount that's going into the stock. So top 10, Visa. Somebody talked about, right? How about Visa? I don't have a stake in this company, but $13 billion was added, either added or new position initiated. And that came out on the top. This was a little surprising to me that Visa actually came out on the top in terms of a new dollar, not new in terms of a dollars added to it. Right? Taiwan, Moody, S&P, these are standard. Microsoft, Meta. Chubb was another one. But I think Chubb is because Berkshire Hathaway took a stake in Chubb. I think it is because of that. Maybe $8 billion coming from Berkshire Hathaway. Yeah, but still we had Microsoft, Meta, Amazon, Alphabet. 4 out of these max 6 have dollar commitments in it. So yeah, I don't think I can say that the max 7 trade is dead. At least that's based on the smart money doesn't think it's dead as of September 30th. In last 2 weeks, who knows what they have sold off. Asif says surprisingly low dollar buys in Google. Yeah. So maybe during the breakout, we will dig into Google and see who bought, who sold, and to know what happened. So keep a note of these tickers. If a question on specific tickers, just hold on to your tickers and we'll get through those on the breakout rooms. Okay, so that was max 7. let's look at a chip sector. Right. So NVIDIA is still the number one. Last quarter, it is TSM was number one, but now NVIDIA became number one with $21 billion. And I don't know how many fund managers are these. So the companies that I look for in these tickers are, I messed up the commas, I didn't have it. So, okay, NVIDIA, TSM, Broadcom, Applied Materials, Lam Research, Texas Instruments, Applied Digital, AMD, ASML, ARM, Qualcomm, KLA Corporation, and Micron. Right. So these are the companies. I think all of them have a stake. So I could have just read from this image itself. NVIDIA $21 billion, TSM with $13 billion stake. Lowest is Micron. Micron has got only one fund manager, David Tepper. I don't know what is David Tepper up to. That sounds a little interesting. Whirlpool. Tepper was hawking China. So we look at, let's say, keep a note to maybe look at David Tepper during the breakout room. We'll see what else he has done if you're interested in David Tepper. Who else have it? KLA Corp, like $83 million doesn't, it's like a change. Overall, almost $58 billion across all these companies. That's a huge amount. Mike says, in my honest opinion, Micron is most undervalued of all chips. And maybe because Micron, I think, recently had a huge jump. And I heard a news, now they signed a deal with what, Samsung? So this was like end of September. And a lot of gains have come out like after end of September. Maybe if they're still invested, David Tepper is still invested in it, right? He made decent amount of money. Right? Again, don't follow anyone else, but I just want to give you across. Looking at an individual doesn't tell me the overall how the Wall Street feels about it. That's why I consolidate and look at across the, all the fund manager who is doing what. Belly Gifford, the firm that I really respect a lot, has the most dollars AUM in chip sector. And I think they also have in the e-commerce sector, if we explore the e-commerce theme, which will be the next. Exploring the e-commerce theme, total amount invested in e-commerce is $75 billion, much more than the chip. In the chips we had $58 billion. Top three rank holders on e-commerce is Amazon, C Limited, Mercado Libre. I'm in the good company. I have these three in my portfolio. Belly Gifford has $36 billion invested in e-commerce. That's the highest. So if you are an e-commerce investor, don't go and read what Warren Buffett has to say. Do they even have it? Or don't go and read what, let's say, let me pick up something which little note. Tom Gaynor or this guy who run this family office. Druckenmiller has to say. Druckenmiller got only $430 million in e-commerce. If you want to think about e-commerce, read what Bailey Gifford has to say. They got a $36 billion, way, way more than the second one, which is Tiger Global. Right? Read what they have to say. Forget Stanley Druckenmiller. Right? He's got a very less capital in e-commerce. Again. So Amazon is the highest, $30 billion. C Limited is number 2, $12 billion. Mercado Libre is number 3. Again, Mercado Libre and the C Limited, I think strong support coming from Bailey Gifford. Bailey Gifford has been an early investor in Amazon and a lot of other e-commerce companies across the world. Shopify is number 4. Then comes the Chinese company and then the Coupang. So I hold. Then I also picked up DLO because I think in Q2, one of you asked for DLocal. So I added that. Not much of an interest. Global e-commerce, not much of an interest. These are like rounding errors. Alibaba, JD, way less. Right, but this is the how the leaderboard is on the e-commerce theme. Right. I also looked at big commerce. There are no takers. And I only picked up the ones which has got at least $50 million. Otherwise, it wouldn't have fit in this screenshot. So that was e-commerce. Any questions on e-commerce? Let's get to the next theme is ad tech. Ad tech means you got Adobe, AppLovin. Oh, this is some app engine. I think DigitalOcean. ATY, CRTO. Some of these came from you guys in the last quarter. So this time I added Magnite, PubMatic, Roku, Trade Desk. Total amount invested, $13 billion. I forgot to put a leaderboard. This wasn't the case. AppLovin was not the number one in Q2, if I remember. But now everyone is, Bailey Gifford is in topmost on the AppLovin. And Cotu has got a $1.6 billion. They talk very highly of AppLovin, but Bailey Gifford has the most investments. And then they are also in Trade Desk, only these two. AppLovin is number one. Adobe is surprisingly number two. And then the Trade Desk. How is Adobe in ad tech? I think someone last quarter, someone told that Adobe should be in ad tech. So I added it. If you don't want it, ignore it. Sorry, I did not. Should it be not in? Okay, let me ask you a question. What other company should be in ad tech that you're tracking and I'm not have it here?
Meta.
Meta, I'm tracking in Mac 7 anyway. And no, this Meta is advertising usage company. It doesn't provide tech. I'm looking at a tech means which provide other companies with the technology for yeah, then even that case, then Amazon will come in because Amazon is DSP. Yeah, Meta will probably be number one.
So does Google.
Yeah, Google. So I think I'll
I
have
think you have to look at it from the ad tech revenue for the entire ecosystem, which is like 200 billion as I last looked at it. And that split, the majority goes to Google and Facebook even today.
Yeah, so they sell most of the ads, but I don't know whether they are the one who provide the technology behind the ads or they have built their own techs, right? Anyway, so if I add it, they probably are always on the leaderboard. TDD, I have TDD. What is TDD? Jose, what is TDD? Oh, okay. Oh, so that's a TTD. That I already
The numbers are really bad. If you compare with AppLovin, TTD
Your
comes
voice
very
is
low.
very low. Who is speaking? You have to get closer to the mic.
Oh man. Okay. Let me type it.
No, can't hear. Asif is given a link for ad companies. All right. For next quarter, I'll add. Or maybe during a breakout rooms, we'll add these companies and see.
A lot of them have gone bankrupt. Like Rocket Fuel has gone bankrupt. Rocket Fuel was like 6 years ago.
I'd never heard of that anyway. Retail favorites. This might be a little more interesting one. Right. Total $10 billion. Smart money is not looking at, hey, what the YouTubers are buying. CoreWeave has got a strong backers in Nvidia and Cotu. Palantir, the hottest stock, it has no love. None of these people want to buy Palantir. BlackBerry is still like old frame what's of Fairfax Holdings from Canada. They still hold. And then Iran is finding some love here. What is surprising for me was a QuantumScape. So QuantumScape is a solid state battery, became very famous today, 2021. Stock was up to $90, then crashed down to I think dollars or $2. I don't know where it is right now, but I was surprised to see that Cotu has taken investment in QuantumScape. Now it is what, $13. It was down to like $3. And if I recall correctly, during the height, it was 90. Oh, it was above 90. It was like $121. So they're building solid state batteries, have a collaboration with Volkswagen and all that stuff. So leaderboard, CoreWeave, Tesla, Grab. So one of you asked for how about Grab? Looks like Grab is finding some love. I mean, it was also there in Q2 2025. So Grab has got $1 billion worth of investment. Who is so Tiger Global has got almost $500 million, and then 200, yeah, little bit coming from Bailey Gifford. 286 million is like, yeah, I want to basically spray my money across everything who is on this Uber or gig kind of economy. Now, Oscar Health, you will see a lot of stuff on the Twitter, no takers. ASTS, smart money as of September is like a Trump change. It's like a Trump change. Palantir, same case. They were invested in Q2. I think they're just holding that investment. Hims and Hers, again, retail investor go crazy on it. Wall Street doesn't think about it. Circle, again, only $53 million. Then the SoFi. Yeah. So if you want to know who else is swimming with you in let's say Oscar pool, not many of them. Right. So this is the lot of retail favorites. If you have any of your favorites, do let me know. Let's explore the next theme. Fintech. So again, Fintech leaderboard is Nubank. Even I think in Q2 it was Nubank, XYZ and PayPal. There is no change, I guess. It was the same leaderboard, I think, last quarter also. Now we talk about Hood and SoFi and all that stuff. Not much of a love. Right? New XYZ PayPal. Chime, after Chime became IPO, maybe some of those fund managers bought after the IPO, holding on it. And then the Robinhood, this is, I think, a payment company, Shift 4, and then SoFi. Not much of a love. Lot more love coming from retail investors, not from so-called Wall Street smart money. Any other fintech company we should add it here? Any other takers?
I think MasterCard and Visa, because
No, Rutva, I can't hear you. Good. AFRM. AFRM. Affirm. I missed that. I should have added it.
All right, can you hear me now? This is Vishal. I'm using my daughter's account.
Okay, now it is little better. Yes.
Okay, so MasterCard and Visa can also be considered as a fintech because the payments world is changing drastically with these stable coins and tokenizing of assets. And they are coming with a technology that's going to change lot many things in coming years. How soon, we don't know.
Okay, so
And
we'll, and I think if I have a MasterCard and Visa, probably they'll be on number 1 or 2.
exactly. And MasterCard is a smaller company compared to Visa, so multiplication chances are better with MasterCard. That's what I think. And another is basically with this the new standards, because the EV payments and all kind of payments are changing. They're coming up with something called as contextual payments. So that world is going through transformation, and there's not much noise except the people who are working in the space. But I think eventually it's going to touch every aspect of life very soon in few years.
Cool. No, thank you for those insights. These are the big behemoths. They have survived decades of disruption, so can't write them off. Even though I'm a big fan of stablecoins, oh, it's going to disrupt it. Hey, they will figure. I'm hoping that they will figure it out. Looking at EV, overall only $3 billion, and no surprise that the leader is Tesla. And again, these hot stocks, Lucid, ChargePoint, Evo, they don't have much takers, right? Maybe apart from Tesla, which is you get a little more dispersion among the fund managers. Most of them are maybe one fund manager who's kind of holding the fort there, right? And I also looked at others, right? I try to look for this is PLNK, blank charging or something. Leodo, Neo, Rivian, Winfast, XPEF, not much of a love. So got a Tesla, Rivian, BYD, Lucid, $7 million. Means nothing when we're looking at 89 fund managers who have like $1.3 trillion. AUM, like $7 million is not even a rounding error. So what surprised me, Ariel investments in BYD. Okay, so as you guys know, I initiated a stake in BYD as a new position this year. So I need to see and read about Ariel investments, what their thesis is. So this is what helps. Okay, whose thesis should I read? Now, finally, the Chinese companies, right? Total amount invested is $12 billion. Two companies account for 70% of that investment. And these are PDD and Baba. And three fund managers account for 70% of the total investment. So it's like very concentrated among the funds as well as among the companies, right? So it's like a go big or go home kind of a stuff. And they're not venturing far out in terms of, hey, let's buy a smaller company. They're sticking with the biggest and the baddest ones. Leaderboard PDD, Baba, and third is Tencent Music, right? PDD got almost $7 billion, Baba 2.5, Tencent Music $800 million, and then everything rest falls off. Overall, $12 billion. Looking at Bailey Gifford, no surprises here that he is in PDD. What's no in Baba? I don't own PDD. Maybe I should. I think that same comment I made in previous quarter because PDD was on leaderboard at that point of also. But I haven't pulled the plug. I've never spent time in understanding PDD. Then number two is David Tepper. Of these companies, still have $2 billion invested in it. He was big last quarter, but you still have $2 billion among these Chinese companies. Then Himalayan, I think this H&H International, he's got $1.6 billion. Everyone else is like low. So Altimeter, Brad Gerstner. I have to see what else Brad has. So let me take a note of Altimeter. So these all are the themes that as of today morning, I was able to explore. I'm trying to figure out what else themes. Give me an idea what other themes should we explore. What else you want to explore?
I think the energy is the one sector we can look at. The reason is, all these data centers are being built, and there'll be more competition because the current capacity what US has is not enough to support the data centers what compute will be needing.
So give me tickers. We got a G, I guess G Vernova, we got a Vertiv. So give me the tickers. So let me open breakout rooms. I'm done with the content that I had. 5 minutes over. Let's open the breakout rooms. I will stay in the lobby and we probably will explore these 30 nets from different angles, whatever you want to. So I'll stay in the lobby to go through that. But if you guys want to talk about something else with other investors in the breakout rooms, go ahead. So let me open the breakout rooms for you guys. Breakout rooms, open all rooms. So so rooms are open. Feel free to go in different rooms and maybe want to talk about charts or options. Feel free to go there. I'll stay here on the lobby and maybe now we can explore from a more angles.
Vivek,
Yeah.
can you track NBIS? I think they are data centers.
Nebius. So we'll look at a Nebius. It's a hold on the tickers. And I will now you can give me the tickers and we can look at who
Hold on.
owns what owns. Ray, go ahead.
Okay.
You have a question.
So just a quick question. I have two questions. So my first one is, I remember a few weeks ago you were looking at like an Excel sheet on how to value a company. So it's basically what kind of future earnings justify this value, or the future earnings, what value does it suggest? Do you have like some documentation or names I can read about how you did that?
So that is called reverse discounted cash flow.
Oh, okay.
Okay.
Is it
And
a It's very popular. If I search on internet, I'll basically find out exactly how you did it.
yeah, so reverse discounted cash flow. If you search for it, there are templates available.
Oh, okay, thank you.
Okay, so
I
basically, instead of it goes the reverse way of the very, I think the discounted cash flow is a very popular among Wall Street to analyze the companies, in which you project how the cash flow in the future is going to generate, and then you come up with those price targets. My price target for this is the value target is like $200 by 2028 based on the cash flow that I see. Reverse tells you I can't predict in the future what's going to happen, but I can tell you based on today pricing what's the growth that we have priced into these companies. I like to do the reverse one. So that's what the Excel sheet was.
I see. Thank you very much. I'll search it. And my
What's the
second
second
question,
question?
so I'm not sure. It's slightly unrelated, but I remember you were thinking about TSM, and I just briefly looked at the TSM leap options, and there's certain leap options. For example, 2 years from now, with the strike of 250, and the price of the option is about, this is calls about $90. So basically, when you do the math for the break even, you just have to grow about 10%. Oh yeah, you have it right there. January 20, or yeah, January 28 or December 27 is about the same. But basically, the math says the break even TSM just has to grow about 10% annually. What do you think about like this sort of betting?
So the stock price, so your break even will be around, because you're paying your break even is, let's slice this to, is 341.
Yeah, and
Okay.
341 divided by is just, I think it's only about divided by 286.
Correct, the
It's
stock,
about,
let's say 290, right? 286, 290. So up to 340, $50.
and then when you divide that by their current price, it's only about 20% gain, or maybe roughly 10% a year. So
Yeah, so I'm not a big fan of buying at the money leap calls
mm,
because you're paying too much for extrinsic value. In this case, you're paying 250, but you're like paying $54 for an extrinsic value of it,
mm,
which means even if the stock doesn't do anything, stock stays here, you're gonna lose $50 just because of a time premium, theta
mm,
decay, right? So I don't want to do that. So if I were to really take a bullish, maybe I will do sell a put or do a stock substitution, which is do little bit deep in the money so that I don't lose just because the time has moved ahead. But then you have to
mm,
do a little more outlay of capital, right?
mm,
So that's how you have to decide. Uh, in this case, the stock has to, I mean, even if stock doesn't do anything, you're still gonna lose $50.
mm. But more than likely, you would think that the stock would grow faster than 10% a year, right? That's your.
To me, it looks like, yeah, right now, because this is the company, business could grow. I don't know about the stock price.
Mm,
Plus, the business could continue to compound at, I think they're growing at 30% plus, close to 40% year over year for last 2 years. Business could continue to grow, but what happens? Let's say OpenAI comes and say, "Oh, we can't meet our commitments." The market will crash,
mm.
and it will bring everything else down. So I can't make any predictions on what the stock price is going to be, but I think from business perspective, they are still have a good order book, and
So if you, yeah.
much
If
bigger.
you were sure that TSM, like you're convicted in TSM, how would you kind of leverage your bet long term?
So for me, I own some stocks, then I can
Uh,
and I just continuously reduce my cost basis on it.
but what
And
if
if
you
it
wanted to
falls,
be more leveraged than just owning the stock?
I
Margin.
I, I don't
Mm,
want to become too leveraged on any bet because market could become irrational and then could stay longer, stay irrational longer than your portfolio can handle your leverage bet position.
mm,
But I'm a long-term believer on this company, and I own some basic, which I will always want to own in my portfolio, some basic quantity, and then I basically sell my options. And if the stock falls down, I'll buy a little bit. If a stock goes higher, I'll probably sell a little bit. If it does nothing, I will reduce my cost basis. So if over next 3, 4, 5 years, I will reduce my cost basis by 20, 30%, it becomes much easier to hold, right?
mm,
And I do hold many stocks in my portfolio in which the cost basis have been reduced by 40%, right? So even if the market doesn't do anything, I'm anyway up. In a way, I'm up 40% because I reduced my cost.
mm. All right, I see.
And
What
that
I would
applies to
add to
every
what
company that I
Vivek,
hold in my portfolio. Sorry.
I'm sorry to cut you off, but what I would add to what Vivek said is like you got to pick your poison. So if you take margin, your position is going to be very sensitive to the price. So if it goes down, you might be margin called. But when you take calls and you buy options, you're going to be sensitive to the date. So you got to be right by that time. So they both leverage your position, and you both can have extended or higher returns, but they both have areas or points of pain, and you just between those two, you got to pick your poison, or even find another way to leverage your position. Even sometimes by taking outside bet and putting it into it and having like monthly steady payments to not be really affected by the price of the stock. But that's a different situation where you have to manage your cash flows, and if you're sure that you can pay principal and interest on a personal loan or something that's similar to that.
And
I mean,
Jose,
the thing about like, I mean, I put it in the chat, but like,
yeah,
Ray, if you're gonna do the strategy, like you should have done it in April. You know what I mean? Like, you need a real, like, we didn't have a real, like, you got to basically have to pick a macro bottom to do that, and unless you do that, like, we're way too close to the highs, and like, you could just get priced out of your options, and like, the theta decay, like, yeah, it only works if you pick a big picture bottom and then buy leaps. Like, if you bought it in April, you'd be up now. But like, if you do it now, like, you're too close to the top.
Mm, yeah.
Once
and
in
this
a
is what I
lifetime kind of
like.
opportunity.
Yeah. And that's what I like about this group is like we have a different types of investors. Like Jose is good on the technicals. He watched 100 MA or 200 moving average and all that. I pay little attention to that. I was looking at a business, and but here's a point. Like, come on, this is where it is. It is haven't broken below 100 MA, so probably it's overvalued right now.
Mm,
Like, if we have another COVID, then like, I would recommend, I would support doing that strategy. Like, if there's another COVID crash, you could do that.
One of the things that you might want to know is at what price do you think you want to buy it and what price do you want to get out of it? If you're ready for that, if you know that, then the option and other techniques can help you out.
Cool. All right, let me bring up my 13F and then
So Vivek, I have a question in the same continuation what is being asked. So I am not an option trader, but I'm a kind of buy and a hold kind of a guy doing for last 10, 12 years, doing well so far. But my question is, like, recently been reading a lot, and it says like basically you should have 20% position into cash, right? So that when the market drops, you should be able to deploy like cash in the market. But I always kept invested all the time. Like I never had any slack. It just market goes down, goes up, as long as the hypothesis is still right. never sell the stock, just stay with it, ups and down.
Yeah.
It paid off, but looking at like there was recently a video by Charlie Munger or something talking about the same thing, like keep 20% in a cash, and when the market goes down, that's where you buy the stock and you will make most of the profits at that time. What are your thoughts on that kind of a strategy?
So having a cash available to deploy, it's a very good. Uh, I can't say that it's not a good stuff. I mean, I'm not gonna get mad at how you're holding a cash. So I think the only idea is how much of a cash you want to hold and for how long you want to hold. And I know the Charlie Munger video that you're referring to because I also listened to that where he talks about a lot of benefits of cash. In fact, I was today morning I was thinking maybe I'll summarize that, but then I realized there's too much of a stuff in that. And I don't think there is any one way, one right answer to it. Okay, I want to have 15% of my portfolio in cash. Let's say if we have had 15% of portfolio in cash since 2008 crisis, maybe you would have underperformed. You need to look at what you're holding in your portfolio, what do you think is it in terms of where it is in its valuation curve. You feel it is rightly overvalued, your portfolio is already uh, done a lot more than you would expected, yeah, move something into cash. Also look at, do you have a need for that cash or not? So the way I look at it is, I don't have a set percentage of cash that I want to keep. I always want to have some cash available on the sidelines to take advantage, but no set percentage. Now, over the last few weeks or months, I've been deliberate in terms of trying to have more cash, but that not that the market is going to crash, but I'm trying to plan for my next years of expenses. In any case, I have to make sure that I have expenses available to run my household if the market goes down or doesn't perform next year. And so far this year, I mean, have had a good returns. So I don't mind having a lower return in future for the guarantee that I'll still have a food on the table and a roof over my head, right? And so I'm increasing, I don't mind increasing my cash allocation to make sure that I have that cash available to tide over any drawdown if it happens in the market. If nothing happens, that's fine. If market continues to go higher, I would have made more money if I not taken sold some security to take a cash out. I now will make less money, and I'm okay to do that trade-off. So you have to think, cash when the market crashes, the volatility in the market is what do you call it, is a people with the cash, it becomes an opportunity for them, right? If you have a cash available on the sideline and the market crashes, that's a very good opportunity. While others are selling the dollar at 50 cents, you can go and scoop them up. That's why the people say, right, the money is made in bear markets, you just don't know it, because you buy those stocks at a cheaper price in bear market. Now when that bear market will come, we don't know. So 5%, 10% cash, perfectly fine. Markets are delivered over the last 3 years, they are up more than 50%, or rather 60, 70%. So if you want to increase your allocation to cash more than what it was usual, sure, not a bad, won't be a bad decision. But I can't tell you should it be 15%, 20%. I don't know what others, stuff you have on in your life. Maybe you have your regular salary coming in. You don't need 20% of it. And so that's how I would approach it.
Thank you.
Doesn't Warren Buffett buying Google at $270 a share kind of break that rule? Because you would have expected him to buy it at 170 or 160, like less than a month ago or more than a month ago. But
So,
even at these prices,
so
he's still buying.
first of all, I don't even know if it's Warren Buffett buying it. I should have talked about it. I forgot. So Warren Buffett has said goodbye, right? So in his last annual letter to shareholders, or letter to shareholder, I don't think if it's not the annual one. He has mentioned that he's basically following through what he talked about during the shareholder meeting, that he'll no longer be the CEO. He's stepping down at the end of a year, and he's now having Greg Abel take it over. So I don't think any investment decisions that's being happening right now is done by Warren Buffett. He probably, because he's around, he probably still gives a stamp of approval, but the decision is coming from, has been validated and approved by Greg Abel right now. So I'm not surprised that they invested in Google, because hey, Greg is like 54 years old. Warren Buffett is 95. So there is a generation gap. He understands these a lot more than what Warren would understand. And of course, I think the initial idea probably would have come from Todd or Ted. One of them would have brought it up to Greg and say, hey, we should take a stake in Google. Right? And when Berkshire invests, they're not investing for next 5 years. Hopefully, that's what it used to be. They're looking for next 20, 30 years. And probably hopeful that even if the market crashes, Google crashes 10%, 20%, 30%, it will recover. Right? So I'm not reading too much into Berkshire, because the leadership has changed there, and the decisions will change. And I like that Warren made it very clear that he'll be also stepping away from any role, because that's what, as a good leader, you should do. You shouldn't be hanging around when you have a Greg Abel, because then he will not be able to do 100% what he really wants to do if you still hang around as a chairperson or associated with the company. So he wants to make sure he gives the full control to Greg. And that could be one of the reasons why they didn't do so many investments so far, because he wants Greg to take a decision. He shouldn't be making any decisions because he won't be around with the company. I hope he lives to complete 100 years, but let Greg make the decisions. So I'm not reading too much into they bought a Google. Hey, they also made a mistakes, right? They also bought airlines at some point of a time, and then they sold it off. But it probably not coming from Warren. Jose says zoom out on SPX if you ever have a crisis, bottom out. Yeah, relative big picture, doesn't matter. So it all has to do, when do you have a need for a cash in next 2 to 3 years? Keep cash. Cash is like an oxygen. Nobody notices unless it goes out, and then we need it, right? So if you don't have a need for a cash to come from your portfolio, then stay invested, because you have a cash coming from your salary, and you think you have a protected job and nothing would happen, fine. That has to be very personal decision. All right, any other question, or we jump on to 13F? What, nothing? 13Fs? Give me one way, or otherwise I'll jump into the breakout room. 13F. Okay, let me open up that sheet, and let's go to okay, let's look at the fund managers. Okay, somebody had, I said, I want to look at what Brad Gersner did. So right now we're looking at what the favorite fund managers did. So you give me your favorite fund manager. We'll explore what the heck he or she did in Q3 2025. So we'll tell you any new position initiated, what did they sold off, what's the value, the current value that they hold, and overall percent of portfolio. So Michael Burry, if you look at this, sold off almost everything. He sold off Regeneron, UNH, Estee Lauder. Remember, he bought a position in Estee Lauder? Last quarter we talked about it, and he's like a trader. Not an investor. Last quarter, their 13F revealed is a big position in Estee Lauder, and now he sold off. Then he sold off from Lulu and bought Lulu again. So he's got only 3 positions: Lulu, SLM Corp, and Molina. Sold off from Mercado Libre, etc. Let's look at Brad Grassner, Altimeter Capital. Again, they do both public and private. Let's see, what did he exit? Datadog, CoreWeave, Samsara. They exited completely from these. New positions, very small. The biggest new position is Broadcom, starting with 3.24. PDD, Alibaba. These are the new positions. And then they, wow, TSM upped their position by 23, almost 25% more, but is still 4% of portfolio. Microsoft, right? Oh, Amazon. Wow. See, added Amazon, increased like 50%. Increased its Amazon position by 50% as compared to between June and September. And now it is almost 6.5% of portfolio. Biggest one is still NVIDIA, even though it sold off 7%. Second is Meta, Microsoft, then Uber and Snowflake at 547 billion. But they've been reducing, selling in all these, but still some of them are the biggest one. Anything stands out from Brad's stuff? Confluent sold quarter of its Confluent position, now it's 3%. Who else did on Confluent? CFLT. Confluent. Octahedron, they also sold off. Who bought Confluent? Stan Druckenmiller, he's a trader. Live Street, little bit of a Confluent. So Confluent, not much of a buyers, but mostly sellers on Confluent. Druckenmiller is like a day, sometimes Druckenmiller is like a day trader kind of stuff. So I don't pay too much attention because he'll buy positions and maybe within week he will sell or next quarter he'll sell. They have a very specific targets for their traders. Anything else you want to look at among, okay, other fund manager, Druckenmiller. This is Druckenmiller's, yeah. So biggest position is Natera. And biggest position is not even, it's like a $500 million. So he's got a lot more positions, right? Then Insmet, I don't know. Teva, I had 5-6 years ago, I had traded on Teva. Then Taiwan, Woodward. But the problem with the Druckenmiller is you never know. They had this position on September 30th, and maybe by October 7th, the portfolio looks completely different. That's my concern around Druckenmiller. Then they got a Coupang, Mercado Libre, DocuSign. Who else? Okay.
I mean, they're not all short-term trading. I mean, it's macro too, you know? Like,
yeah, so Natera, you got Natera, Natera calls. Someone also owns calls on Natera. We'll look at it. Okay. Who else owns Natera? Everyone else has no conviction on Natera. 0.27%, less than 0.1%. And who owns Natera calls? Okay, he has a stock as well as calls. Okay, so only Druckenmiller knows something about Natera. Looks like I've never heard about this company. I mean, I've never looked at this company. Any other company you're interested? They got options on SPY. Now, I think this is notional value, not the premium that I paid. What other options they had? They got IWM calls. Yeah, everything else is like small. Shall we move to other fund manager? Any other fund manager you're interested in? Looking at what did they buy or sell? Berkshire. We didn't look at Berkshire. Not Berkowitz. Apple is now 22%, 60 billion. American Express, Bank of America, Coca-Cola, Chevron, Occidental, Moody's, Chubb. Remember 8 billion? This is where 8 billion Chubb came from. They added into Chubb. KHC is at Kraft Heinz, Alphabet, 4.3 billion. So Alphabet is now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th position in this $4.3 billion. They sold some Apple, looks like 15%. What is it? 1/3 of this Verisign they sold. Mostly no change. Typical Berkshire. It added into Chubb, added into Sirius, added into Domino's, added Lamar, exited from only one completely, which is DR Horton. Others are very small anyway. So, yeah, only one new Google position. Nothing much to look in when it comes to Berkshire. But let's see what else happened on Google. Dang it. Two separate tickers on Google. So we'll have to go and look at two. I see a lot more reduce. Co2 updated their Google by 260%. And GOOG. The Co2 has taken some big position on Google. Let's go here and look at Co2. Highest is Meta. Microsoft number 2. New positions. Synopsys, which is a EDA company. Applied Materials, new position. But Alphabet GOOG is a new position. And I think they also GOGL, in which they increase their position. So overall, if you look at Google, 4.3 plus, it's almost 5.5%, right at number 3 or number 4. So Google is like, so they're sticking with the tried and tested, right? Meg 7, Meta, Microsoft, Google, then comes Taiwan, Giovanova, then Amazon, Broadcom. NVIDIA is now low. They reduced NVIDIA position by almost 14% and sold CoreWeave 62%. Wow. How about AppLovin? You add it. So this is the concern which I have is when you look at these, like on the financial media, you'll see them talking a lot more about, oh, this is a great company, we love investing in it. And then you come and look at the 13F, oh, they reduced their stake. So Brad Gusner did with Uber, right? I'm like, dude, follow the money, don't follow what he comes and talk about it. On the CNBC, he's been saying it's been a great company, it's this and that. And then you look at it 13F, you're like, oh, come on, he's been selling it. So now look at Co2, they sold off 62%, like 2/3 their position in CoreWeave they sold. Now this is as of end of September, right? So things could have changed. And they sold off half of their position in ARM. If you're so committed to it, right, why did you sell? Cadence, they sold, maybe they rotated from Cadence to Synopsys because both are similar competitive company. What else they completely exited? Eli Lilly, Philip Morris, Appaloosa. Jose say good to take profits. Yeah, but then be clear and saying, hey, I am like I'll take profits when it's we are a long-term believer in this, and then you sold off a next quarter. That's just what I hate. You can do whatever you want to do. Just be open that what you've done, and when you come on CNBC. What I hate is different. You talk differently and then behave differently in the market. So that's why I'm like, don't follow what they say, follow the money. Wow, Whirlpool. Tapper, Mr. Tapper is seeing something on a Whirlpool that no one else. He's increased his position by almost 2000%. WHR. What is he seeing in Whirlpool? Who else is in Whirlpool? No, that's it. It's only, I mean, 0.64%. It doesn't matter. So David Tapper is definitely seeing something. So maybe we should go and see either like reshoring. What is Whirlpool doing? What's got David Tapper interested in it? That it invested, it became now his third biggest position. The biggest is still Alibaba. Even though he reduced it, Amazon, Whirlpool, Nvidia, Alphabet, then Crane shares, this will be KWeb. So it's still big on what do you call China, right? So China is still 20% of his portfolio. Then you add Pinduoduo, JD.com, Baidu. Yeah, it's still 30% of his portfolio still in Chinese companies. But he sold off, what are the bigger cells? Right, let me see if I can sort with. Oops. What the heck did I do? David. Okay. What else you want to look at? He got rid of UNH. Let's go see. Doesn't show up as an exit. Does UNH still there? United. Oops. United Health Group. Yeah, almost 92%. Yeah, it's like right now it's still up close to 1% of its portfolio. Yeah, it sold 90% of its holdings in UNH. What else? Want to look at
What are
it?
the managers? What are the managers doing with regards to the AI value chain? I'm talking cooling like Vertiv, memories like Micron, your Lam Research, and what are your views on it? And like, are they overstretched with valuations, or is there more room to run with these names?
What are they doing, or what that we can look in? Let's create another one called AI, which will include, but AI, all these will include AI, right? So then we'll have to add some more. GE Vernova, or shall we create a separate one for energy? And then we can look at how are these managers doing. What do you say?
Yeah, I think one for the semiconductors for all these names, maybe.
So this is chip stocks. Maybe, oh, sorry, let's call it an energy, right? And let's pick up the energy stocks. Somebody earlier was saying we should create one for energy, so now we have one. We got a G. Give me some energy ticker. GEV. Right. Okay, let's add more. Vertiv is VRT, right? Is VRTX or it's VRT? I think
VRT.
VRTX, I think Vertex Pharmaceuticals. Which other? Oh, I think I had. Oh, did I not have Oklo under the retail? 89 fund managers, none of them have any positions in Oklo. So it doesn't even show up. No positions in Oklo. BE is there. Okay, I'll add this. Oops. Okay, let me add, which was the one? Oklo did not have any takers, right? So let me at least take a note of this that we looked at Oklo. What others on energy? I want to do XLE.
CEG.
Sorry, which one?
CEG, Constellation
Oh,
Energy.
Constellation. Constellation. Constellation got only one, Q2. So G Vernova, again, I think the Q2 is because they are on the tech side. So they're picking up they have an investment in chips, they have an investment on the energy side. And EE is what, Nextera?
Yes.
DVN, I think, is Devon Energy or not D. I've never. Yeah, so we got some love for Devon Energy. Oops, I should have said add to this. Add to the current one. Sorry, no love for Nextera, man, out of these 89 people.
XOM, CVX.
Oh, now we're going to the traditional CVX should show up in Berkshire Hathaway, right? Berkshire Hathaway, I think they had a position in CVX, right?
You added VST.
Oh no, not VST, was Vistara.
Yeah, Vistara.
This is energy company.
Yeah, they are nuclear.
Okay, one of those newbies. Yeah, VST. Wow.
SMR.
SMR. You're going on to the far side of the risk curve. So these nuclear companies have no. Okay, let me take a note that SMR is another company. Have no revenue, nothing else, but are jumping on the theme. What else?
OKE.
OKE. What's that?
I'm looking at the XLE and I'm looking at the top 10, and that is what I'm reading it out.
Then, oh yeah, CVX, like Warren Buffett is the only one. Like old. So Enphase, SEDG, ENPH,
EXE.
SEDG is Solar Edge. Nope, no love for SEDG. EXE. I have no idea which is this company. Which is this EXE? Which is okay, let me just see.
Expand Energy. Expand Energy.
Expand Energy. I've never heard about it. How big is this company? Wow. So enterprise value $32 billion. Yeah, I mean, I don't track this sector, so not surprising. Apart from a big known names. I don't have much idea about these companies. And of course, GV, Vert, even Oklo, these have been because of AI plays. I get here, keep hearing in the news, but so then if you got Chevron, that why not Exxon?
TRGP, TRGP.
This T.
I don't know if you have the data on this one, but Saudi Aramco is is probably the biggest player on here.
Yes, but they don't trade on US market, right?
Yeah,
FANG.
only in the Saudi market. So
Yeah. So unfortunately, will not. I mean, so there may not be, even if there is a data, there may not be 13. Maybe some companies probably would have had a stake, but there may not be filed on 13F.
FANG.
Yeah, that's what I added. I think someone, Jose is saying FANG.
Okay. HAL.
Hold on. Okay, that's what I'm like. Why does it doesn't show up? Because I have some filter over there. That's why it didn't show up the investments on NEE. I have, I think, maybe more than $50 million worth of filter. So, sorry, which one?
FANG. FANG.
Yeah, FANG I added. FANG is already showing up. It's $145 million.
CPRA.
CTRA?
Mm-hmm.
The names I never heard about these. Where are you pulling these from?
I told you already.
Oh, you're going through that XLE, but
The top 10.
Coterra Energy. Oh, see, I should have done this. I used stock analysis, okay, and bridge total energy.
There you go.
Yeah, but we want to know what are the energy companies that we are tracking and which are the fund managers doing it. I own XLE in my portfolio, right? I don't look at what other things. I know XLE, then I know GEV, VRT, and all that, which companies I heard of, and then I'm saying what other fund managers are doing.
Halliburton.
What's the ticker, Halliburton?
HAL.
Oh, HA. No. I have a U-Haul, nothing else. At least these 89, none of them had anything to do with Halliburton in this previous quarter. Neither they sold, nor they bought, nor they hold. XIACY. This must be OTC. Looking at the ticker, it looks like.
Okay. The CTRA will show up in the next time because there is a lot of buying happening in the last 10 days or
CPRA.
so. CTRA.
CT.
Yeah, there on the top one. Yeah. TPL.
Okay, CT. Are we running out of space? TPN.
LL.
Yeah. No. No. TPL. Let me take a note. And what is TPL? Texas Pacific. Oh, isn't this the company which says has given immense returns for shareholders over its lifetime? Yeah, but over last 2-3 years it's had a bad. But this shows in some, when you look at some of those, hey, the companies that have returned gazillion percent over 30 years, that's the TPL. This is where I've heard the reference of Texas Pacific. Never owned it, never analyzed it. VLO. VLO. Probably Valero. VLO. Okay, maybe we can accommodate one more before it becomes eye testing. Why? ET. I don't know if I deselect every. Oh, come on. Then say ET and say add. This should work. Oh, cool. And E and B. All right. Done with the energy list. So, yeah, pretty study. So GE Vernova is like a non-traditional one, but got propped up by all AI and the demand from AI. I think Constellation, the same stuff. VST, probably the same. Others, I don't know. But looks like the smart money is sticking to the names that we've been hearing, right? GE Vernova, VST, Constellation, all providing energy to, again, same as the data center story. Nothing, nothing more than that. It's a data center story. Anything else you guys want to look at? This is a chance. You want to look at for your stocks or, okay, let me just, oh, I didn't.
Can you check who's buying Micron?
Micron. Let's go to, I think somewhere, yeah, okay, let's, okay. I already had a grab. See, grab. I think this is from a last quarter. So I'll look at Micron, just give me a sec. Someone asked for grab. There have been additions on grab. Bridgewater, Ray Dalio, but it's only $91 million. So grab, even though for Bailey Gifford it's 0.21%, but it's got a lot more money on grab. Okay, the other thing that you need to look in is, let's say, if you're looking at a Bridgewater or some of the other advisors, not all of their investments in reported in 13F. There are, so these fund managers actually file two type of forms. One is ADV form, and another one is 13F form. Some of the investments, like say they're private investments or non-US investments, there is some criteria in which they qualify to be reported under 13F. So I only realized it because I was looking at one of the fund managers. I'm like, they have a more asset under management. How come 13F shows only this much? Then I saw that they reported under, there is another form called ADV form in which they report the other assets. So saying Bridgewater has got 0.36, probably it is because of the 13F or, I don't know, maybe Bailey Gifford has the under ADV, they might have reported something. But that's as a different criteria. Sorry, just want to say, and you mentioned which stock? Micron. Okay, let's go to the chips. Otherwise, I will screw up this one trying to do Micron here. I don't have a stuff on the bottom. Okay, let's add something from there then. To do individual stock positions, let's add, I'll maybe give a little more space. Okay. So let's do Micron, MU. Okay, I have all. Wow. There's no filter on this one. I have everything. No one added any position in Micron. David Tapper sold, Guy Spear sold. Only these two activities on micro, nothing else. Yeah, only two fund managers acted on Micron, looks like. No one added anything into Micron or did anything else. Yeah.
It already lost a lot of value, so it might be a little bit overstretched with valuation.
Again, this is as of end of, or I'm saying, did I goof up in terms of, I'll switch back to APP here, but Micron, nope. Yeah, so only reduction. SNDK. SNDK. Only Stanley Druckenmiller put 18 million up. But you could have traded out or next day, who knows? Because SanDisk has been, I'm sure probably he already sold that position. SanDisk has such a high, after September, which we are looking at here, it's already up more than double. And those traders, they don't want to give up these gains. So I'm sure probably they already sold off after 100% run.
I would love to see how much of long-term treasuries do they hold. Maybe TLT.
TLT, we can look at. No TLT ETFs.
Can you take a look at the Talos Energy, TALO?
Back at TAL. Nope, no takers on Tallow.
Yeah, it's coming from the bottom.
No takers on Tallow.
Okay.
Let me also add this stuff at the bottom. Look at, I'll just put GEV just for fun. What else? Otherwise, we are done for today. Let's group it. New position. Who Chase added, reduced. No one completely exited their position on GEV. TAL is a Chinese company. I think I do have a Chinese. I did include TAL, but there are no takers on TAL. I mean, so the reason why I keep this is so that I know eventually what all the companies that I try to find out for. So these are the company Baba, BEK, Baidu, and TAL is there. Pony has some investment, $153 million. Neo, no takers. Vips, $20 million. TCHY, Tencent, but this is OTC, probably no takers. TME is Tencent Music, which is number 3. All right. If maybe you ping me on a meetup or on Twitter or X or on Slack, what other themes would you like to see? Because every quarter I was trying to, okay, what else can I share? So I think last quarter I started on this thematic stuff. So this quarter I added more themes. Now we have almost 8 themes. There could be a few more that we could look at, and I really want to look at across these, which makes more sense than looking at an individual manager. So Biotech. Okay. And then it will be appropriate if you also give me a robotics. See? Yep. Yes, then we'll find out what are the tickers that should go into these themes. And hopefully I think right now I can still spend some time this weekend and do this. Yeah, I'll post this on X with some additional themes. So you'll get to see it.
Before you close out, Vivek, I wanted to just like take your quick thought on again the value chain of the chips and on these names. And what do you think? Is it really the valuations overstretched, or is there still more room to run?
So I think some of the on the chip side of like ASML is there are some companies that I invest and I know about it. There's some companies where I'm not looked at from a valuation perspective. So I can't talk about those individual ones. But let's say some of the companies, TSM or ASML, I don't think they are like super overvalued or they are egregiously overvalued, right? Some of the other AI players, let's say, I would say that talking about Palantir, right? I've been talking about it, it is egregiously valued. Right? But I don't know about, let's say, Lam Research or KLAC because I never invested on those. Overall, the AI and the chip sector is overvalued. It's not available at a reasonable price. But does that mean that it's going to correct soon? I have no idea. Doesn't seem to be the case that it is overpriced yet because market is willing to, buy the dips. We get a 5% dip, 6% dip and on some of these, and people are coming and buying these up. But I feel that it is overvalued, and hence all I can do is I don't want to sell the stocks, but I am okay to sell covered calls or a call spread at a higher deltas. That's all I can do to manage it. But when it will, if it is overvalued, if it is a bubble, whether it will break, when it will break, we have absolutely no idea. Jose says, look at QQQ charts pre-2001. Raw, still the circular economy breaks, stocks are not overvalued. There have been concerns around this incestuous relationship between this chips company and the LLMs company and all that. Right? But I think, like I said earlier, the bull market doesn't die of old age. There has to be a catalyst. Which that catalyst would be? Maybe OpenAI comes back and say, oh, $1.4 trillion not happening. If that's the catalyst, every company in the tech sector, forget about if they have anything to do with AI or not, stock price will come down. Because when the fund managers or the investors, they rush out for a cash, they will sell whatever they can, right? Not what they actually want to. So then every stock will get impacted by it. And so is it overvalued? Yes. Is it a bubble? Are we at the peak of a bubble? I have no idea. There's a difference between overvaluation and a bubble. There are many companies that have stayed overvalued and have caught up to their valuation. Amazon was never available at a cheap valuation. It was always overvalued, except I would say last 2 years. When I invested first time on Amazon, like I watched it go from $600 and super expensive. It is a pre-split. And finally took a courage and bought it at $1,600. It was so difficult if you don't buy at 600 to buy at 1,600. And that still turned out to be good. It was still overvalued. But the issue is, hey, have they entered a bubble territory? We will see. We'll only get to know when when everyone is saying it is bubble, I don't think we are in bubble. When everyone says, oh, there's going to be sunshine, it's all, it's all grass is green, roses will always stay for red, all of us gonna make a lot of money. That's when I think I get scared around, oh my gosh, no one is thinking about bubble. So I guess there may be still a time for this to grow. Sorry, long answer, not even exactly an answer to your short question, because nobody knows. So you have to do what based on what your needs are and what you're holding in your portfolio. I hold SCHD, which is now I think top 5 in my portfolio. It has done nothing for this year, or I would say has done nothing much for last 2 or 3 years. So this year SCHD is actually down 0.7%. Let's go for 5 years. 5 years it is up only 33%. Right? And you will
Yeah, but
ask me,
you're
why the
looking at
heck
the
are you
low.
holding this?
You're looking from the low.
No, 33% is a selected period change.
Yeah, but
So what I picked a 5-year period. Let's say pick up 3-year period. It is back where it was like say close to 3 years, only 7%. Right? Which
yeah,
is like, why are you even holding this stuff? But
so the overall the market is down by 2.69 for the SPX. NDX is 4.48 and RUT is 6.04. This is not anything to be concerned about at this point.
so
If it goes by 10%, I would be interested in adding some things. And I can change my mind at that time, but at least that's where I would be adding.
So if I look at, but the reason I hold SCHD, I'll just finish that conversation, is because when the market zigs, it will zag. When the SPY was down, SCHD is either flat or it was actually up. So I'm like, oh, yeah, I'll hold it in my portfolio. I hold Berkshire for the same reason. Because I don't know when this bubble, if it is a bubble, when it will burst, and there is no benefit in trying to spend any, time in trying to figure out. All I can do is just make sure what I hold in my portfolio. Are there some things that will do better when the market corrects? Will correct less or maybe go up, and that's all you have to do with your portfolio. So let's look at QQQ. Yeah, QQQ is down only 4.23%. You're right. And it looks like if you CNBC is telling, oh, the market is crashed. It's only down 4.2% from its all-time high. SPY not even down 2.5%, and it is up almost 15% for the year. So life is still good.
I have a question for you.
Yeah.
The ETF and other money managers, they have an expense ratio. Do you have an expense ratio for your portfolio?
Great question. I don't know, maybe we look at the commissions that I pay. I never thought about this actually. So what do you give me a question behind the question. What's your thought process behind this? Asking this.
I don't know. I was looking at some information and I came across the expense ratio to be one of the things that you should be monitoring to see how you're doing in comparison to the other things. You have the SPY and whatever the expense ratio, you will have that same expense ratio on that particular position. But if I'm not having any individual ETFs or anything like that, my expense ratio is the total amount of commission that I paid for the year divided by the amount of total market value that I have. And that comes to 0.05 for me. At least that's what I think, roughly. So that's where I'm coming from.
So I think that's a great thought. I've never looked at that, but that's one is the commission that we pay. The other thing what we should look at is how much time we spend in actually trading and what's the reasonable per hour that you want to allocate to that. Because when the fund managers, they basically also involve the cost of fund manager, the cost of administrative cost of office buildings, etc., then the trading cost. Right now you accounted for the trading cost, which is commissions. But we should, if you have to do the really compare it with the same manner, we should also account for our the cost of doing the business, which is per hour. Let's say you spend 2 hours every day in executing these trades, etc. What's a reasonable amount of salary you want to draw for per hourly? Include that. Third is if you have any setup or rental office, etc. I think that would amount to be a total expense ratio. Great thought. I've never looked into or never, added this while reviewing my portfolio.
Yeah, but if you're going to be working for somebody else, you don't have any other things. You just have to work and they pay you whatever that they feel is appropriate amount, and you take home with that one. But here, if you're not withdrawing anything and you're doing it, just investing, that's entirely different thing.
But there's an opportunity cost, right? Hey,
Yeah.
the idea is, if the idea is, hey, there is nothing else I will be doing anyway. If I'm not doing this, I'm not going to earn or do any other work. Then yeah, your opportunity cost is zero. But I don't think that should be the case, because you still have to run your house.
I would probably
Again,
add the margin interest that I paid on the account and other expenses that it might come across, like internet connection or whatever that you can take as an expense. If you're running it as a business, that is what I would include.
Correct.
But if you're not running it as a business, you cannot include all of those things. But you can give, at least you will know exactly what is your expense ratio for your portfolio. And then take a additional amount of expenses on top of that and consider that is the maximum that you're willing to pay. Say, for example, if the expense ratio is 5.5, and if your total expenses for the year is 0.05, you can take that 0.45 as your income.
Yeah, I think that's a good thought. I'll track my drawdowns, etc., but I'd never looked at doing expense ratio and say, hey, how much am I even spending? Of course, I look at, at the end of the year, okay, how much commissions I paid. But beyond that, I've never tried to see what's the overall the ratio is. But it's a good thought, good exercise to do. Only thing is, if it becomes too cumbersome to calculate these, that's the trouble.
I think the valuation itself is its own reward. To me, it's a hobby. It's fun. Like I'd rather do this than do a lot of other things. So making money is kind of like a good kind of side effect of that.
Yeah.
So
I mean, hey, even if someone is not paying for it, I would have done this anyway. For me, the fun is in the journey. I just enjoy the process. And yeah, sometimes you make money, sometimes you don't make money. And I've gone through the years where I have not made money, right? But hey, I enjoy the process.
We have all gone through that steps, like lost money, broke even.
No, I know of some people who wanted to come in only to make money. So after 2022, they disappeared. So, oh, guys, I can't make money. I'm like, come on. So don't come with the intent of only making money. Then you just do ETFs and be happy with it, right? Index, there's no shame, right? Buy 2 or 3 index ETFs. Asif did a great job of giving the tickers, and be happy with it. Unless you enjoy the process of investing, don't get into this.
Your box trade.
Get a job.
I have a question regarding the box trade that you did. Did you have a margin when you got assigned, and then with the box trade, that margin is gone?
No, I didn't have any margin call, etc. Right? So,
not margin call.
Okay.
But did you have a margin that you had to pay any interest from that position?
Yes, because the margin show up if my cash balance becomes negative.
Right.
So that's when it means you're borrowing that much amount of a cash from the bank, from the broker.
So that's the time you added
correct
20,000 for your position.
Yeah. So basically, I use the buying power of my portfolio to give me cash.
Okay.
And not pay the margin interest.
Yeah. So that's what I wanted to know for sure, whether it is or it is not.
No, that's what because I had some puts got assigned. I actually had a negative balance even the previous week also because I had some put assigned. Then I was thinking maybe some covered call will get assigned and then sell it, etc. Then I see the Palantir has fallen down below it. So I thought, okay, let me just raise the cash for and not pay the margin interest. So my cash balance became negative.
The other side of the question is, if you sell some shares, you get the money into your account. But if you're selling short, you don't get that money into your account, but they would consider it as a part of some other different type of calculations. Have you seen that?
When you
If
say
you take
don't
a
get
short
money,
position, short sale,
so I do get a cash in the account, right? Because my cash balance gets increases if I do a short sale.
but it might not be. If you're already on the margin, they would consider it as not a separate information that would be added on to your margin.
I don't know what exactly you mean.
I have to figure that out too.
Okay, because
I have some short positions and they consider that as still a short. It is margin. They hold some margin against that one.
Yeah, that they will. Yeah, I mean they will hold a margin against it
No.
because you are having a short position. So
that's what I need to figure it out and then try to adjust that my position.
yeah. So I have gone into sometimes, the short call will get assigned because I did not roll it or something. And then I'll end up in holding negative. I think somebody had like negative 200 QQQ in my portfolio. And then I was like, should I hold it? Should I close it? And when I have that negative QQQ, it does consume the buying power. It will tell you that so much of a buying power is tied up in it. And then sometimes then I'll basically close it to free up some of the buying power, but then the cash goes down. So it's both ways.
For more risky names, they will take even more buying power,
Yes.
even if it's like the same dollar value. They have a certain metric where they assess the riskiness of a certain name and decide how much buying power they would take out.
Yeah, and not only it doesn't differ only from ticker to ticker. It also differs from your trade to trade and what kind of a level privilege margin account you have. Let's say if you have a normal margin account, which is called Reg T margin account, if you are selling a put, they'll block some margin. If you're selling a call, they'll block some buying power, right? I have a portfolio margin account. So if I sell a put, they'll block margin power. But if I sell a call, they will actually look at a portfolio level. If I can lose either only on one side, right? I can't lose on a put as well as the call side, right? So then you get then they will margin your trade based on at a portfolio level. So it's at a ticker level, it's at a portfolio level. Both comes into account when the brokerage is trying to margin or hold the buying power for your trades. And I've seen in some cases there is a no margin relief because it's some obscure ticker, hard to borrow, Chinese stock, or pick up something, and then there is almost no relief. If a stock is trading at $100, and if I'm trying to buy the stock or sell a put against, do a short put against it, it will block like 50% of the capital. Whereas for a normal stock, it will block only 15%. So yeah, it depends on stock to stock. And also what kind of a margin you have with the brokerage. All right, guys, I'm super hungry now. It's I gotta go out for lunch, but thank you for joining in for 300 sessions, and thank you Ramesh for a message. Yeah, I hope to continue do it as long as it helps me in fight Alzheimer's in later years of my life. So love to stay engaged. This is one way I can stay engaged with the markets and come to talk to you about it later on. Maybe next year we'll start doing later part of next year. Probably we'll want to do something in person right now, just don't want to commit myself to anything else. Maybe once the kid is out, I'll have a more freedom to commit myself for some in-person meetings. So I know many of you are from Bay Area. We can then meet in person. All right, guys. Thank you very much. I'll talk to you again next week. Yeah, so next week will be a smaller than usual because I'll be traveling. I'll probably take a call from the hotel. I'll ask them for a little extension, but we'll see. Maybe from 10 to 12. Then I have to vacate the room.
Vivek.
Thank you for keeping this up, man, and congratulations on 300.
Thank you. Thanks a lot.
There are still option group is going on.
Oh, there is a breakout room. Folks are still there. Okay, so then I'll have to make someone the.
And the swing trading group is busy. 4 people in there.
Okay, I need to then let me ping Jose to see if he can be alternate host. And I need an alternate host to continue the breakout because I have to drop. Okay, I'll get into the swing trader and ask someone if they can with alternate host. Then I'll drop off. All right, guys. Thank you.
I can be the.
Oh, you'll be around?
Yeah.
Okay. Oh, because
No
I didn't
problem.
see you in the breakout room. I thought maybe you also plan to drop off. Okay, then I'll make you as a alternate host and then I'll drop off.
Okay.
Cool. Thank you.
Bye.
Bye.